Well, let's get started. Welcome. My name is Roy Maddox. I'm the host along with Wesley, who's a portfolio manager as well. We're hosting the program tonight, and we're looking forward to sharing with you and exchanging our views as well as understanding your views and from the members tonight. And the agenda is going to be as follows. We will have about an hour of a presentation going through a slide deck in which we describe the market condition. We'll describe various technical and macro factors that are affecting the market. We'll look at some charts. And then the second half of the program, we'll talk about individual stocks. And most of us are here because of that feedback that we're getting in terms of locating and identifying the true market leaders. The topic tonight it's spring showers and flowers. Storm clouds have arisen over the past month, and we're wondering if this is going to be, if it's going to help the market and provide a lot of flowers or bust in the oncoming weeks and months. So we'll cover our outlook, and we think that'll be very valuable as well. This group is comprised of over 2,000 members across the country. And in fact, we also have many members in other countries as well, overseas. And we've been hosting the program for over 5 years. We're followers of, really disciples of William O'Neill and the IBD Can Slim process. So a lot of the things that we'll talk about tonight will be surrounded and encompassed with from the book, How to Make Money in Stocks by William O'Neill, who was the founder of Investors Business Daily, and who is famous for coming up with the acronym Can Slim. So sit back, enjoy. We welcome your comments, and we look forward to having a great and productive meeting tonight. Again, this is a little background. You can find us on Google. If you Google the Charlotte Investors Business Daily Meetup group, you can see that we've got 2,000 members. It's easy to join. There's no charge. And the whole reason, the sole reason that we put this program on is because we want to share and educate and connect investors across the country so that we can hone each of our skills and master the intricacies of the stock market. This is our disclaimer. Remember that the stocks that we're discussing tonight, by no means are they recommendations. Please consult your financial advisor and conduct your own research in terms of making any investment decisions that that may seem like great ideas from the meeting tonight. Can Slim, of course, most of the members are very familiar with this. This is the acronym that Bill O'Neill came up with when he computerized data, and he went back and studied the great winning stocks for over the past 50 years. And this is going back, he began, I think, in the business in the early 60s and was famous for generating enough money in his own account to buy a seat on the stock exchange. I think at that time he was one of the youngest people to ever do that. And he's had a phenomenal career. And many of us have been mentored by him over the decades. I, in fact, met him in 1988, along with his protege, David Ryan, at a seminar. And it basically changed my life. So I've been practicing this methodology for over 3 decades. And again, I won't go into the individual intricacies of each of these of the acronym, but you can find all those online at the investors.com site, as well as in the book, How to Make Money in Stocks. Tonight, we'll talk about the technical factors in the market. We'll also describe some fundamental analysis, and we'll also look at some macroeconomic narratives that are on the table today. So I think all these will be very interesting and useful tonight for the group. Technical analysis, we think, is very vital. And this is basically looking at the chart and understanding the chart and understanding price and volume and supply and demand. And you have various technical indicators that one may study. And all these are covered in books such as Technical Analysis by Edwards and McGee, which is really the Bible of technical analysis. And you have many other textbooks and authors such as Martin Pring and Tom Dorsey from Point and Figure. And we recommend you really studying these because they can all be vital instruments and tools in your toolbox. We really look at the MACD and price phase, stochastics. We do look at point and figure, but most importantly, it's the trend that's most important. And the market has been in a choppy environment. It's really been in a trendless, choppy up, down market environment where most are not able to find any traction in the market. Stocks that are breaking out aren't working. Stock participation is very low currently. Breakouts are really not working. You're getting stopped out and kind of sort of chopped up. So we don't really have a great trend in the market, and we don't have many stocks that are participating. We'll talk about this later on tonight as we look at the new highs and new lows and the advanced decline line, the percentage of stocks above moving averages. We think all these are vital. For us, the most important concept of trend is when the 10-day EMA, that's the exponential moving average, is above the 21-day exponentially moving average, and the intermediate trend is positive when the 21-day is above the 50-day. The long-term trend that we utilize is based on Stan Weinstein's early work in the 70s. And we're looking at the market to be over the 30-week moving average, which is very close to the 150-day moving average. But Stan has recently really adopted his approach after talking with Mark over the last few years, and he's now using the 200-day moving average. We look at the VIX, and we'll probably look at the National Association of Active Investment Management Exposure Index to see how invested active managers are. We'll also look at the credit markets to look at the high yield option adjusted spread to determine if the credit market is healthy or not healthy as well. These are just some of the concepts we'll talk about tonight. For fundamental analysis, Wes and I get most of our information right from Investors Business Daily, and we utilize a product by the name of MarketSmith for screening and charting purposes, where we can get all the fundamental information that we're looking at, as well as their electronic version where we can screen for earnings per share rank, relative strength rank, sales margins, return on equity. So we think that's vital. And the Newsline, the news service, it's electronic now. We think it's vital to keep up with your stocks that way. Macroeconomic analysis is really looking at where the market is from a macroeconomic level. And we use Keith McCullough from Hedge Eye Researching. Keith has us in a quad 4 environment right now. And that's an environment where GDP growth is slowing, and the market narrative is deflation. Now, that's useful because in this concept, and this is he's got a model that's based on the rate of change in various economic indicators, and in this quad 4 sector, there's certain groups that perform better than others. For example, long duration treasuries and medium duration treasuries perform great. And Wes and I have recently, and we've talked about this ad nauseum in the last 2 meetings, about raising our bond exposure, and we actually have about 15 or 20% in medium term bonds, anywhere from 5 years to really 20 years. The TLT and the IEF are our biggest positions in the ETF market. So we think that's useful. And with that, I'm going to turn it over with Wes to go through the rest of the slide deck and some of the things that are happening that are affecting really sort of market direction and that might assist us moving forward. So with this, I'm going to turn it over to Wes, and I'm going to come back and talk extensively about the individual stocks that are potential leading stocks today. So with that, Wes, yeah.
Hey, Roy, can I ask you a quick question before you jump off?
Yeah, sure, Chris.
Yeah. Good evening, everyone. But what does inverted yield curve deflating like it is from going from almost the 1% to almost down like the 60.6? So what you make of that?
It's definitely suggesting that we're either in a reflation or excuse me, we're in a recession, or the recession is imminent. And we'll actually cover that in the slide deck. Thanks for asking that. You got ahead of it, Chris, and Wes will cover that shortly.
Okay, thank you.
You're welcome.
Yeah. All right. Thanks, Roy. Passing it off here. I'll start going through the rest of these. And I saw a Yogesh. It looks like you shared that that link about the TLT outperforming. You know, we're not sure if it's going to outperform, I guess that's the market, I guess, from here, but we do like the risk reward. And you know, I think we really hit on it quite a bit last month when we showed, you know, the TLT, the TLH, and the IEF as those options to get a little more juice from your bonds just with that duration. So depending on, you know, how much risk you're kind of willing to take, you can move out further on that duration with those ETFs. So please take a look at that last month if you want to take a look again. But so another thing we talked about last month or 2 months ago was this Deemer thrust. Well, this is a different one that I guess signaled this thrust signal, which we think has a good record of showing real improvement in the overall market from an individual stock basis. As we know, you know, since the Walter Deemer thrust signal back in January we talked about, it's still been choppy, right? And so it's not necessarily all clear, but it's all these things. This Marty's wide breadth thrust that signaled on March 31st is just really another incremental positive that we think's developing, because the bottoming process is a process, right? It's not like we know the day that the Q's bottom was December 28th still, but you know, before we can start getting real traction in individual stocks personally, and you know, getting that easy dollar environment, it's just a longer process than that. So this is a signal that Marty's Y came up with, and it's derived from the ratio of advancing stocks and declining stocks. So very similar to, again, the Walter Deemer thrust, and it happens when the 10-day moving average of advancers to decliners moves above 61.5%. That's the signal there. It's actually sorry, it's going, I think it has to go from below 40% to above 61.5% in that 10-day period. So it's not enough just to have that level achieved, right? It has to be this really, really quick, powerful improvement in individual stocks. So that means that we're going from a very low, you know, level of advancers to decliners to a very high level of advancers to decliners in just 10 days. And so we did get that signal on the 31st of March, which I believe was a Friday, just 2 Fridays ago. So not Good Friday, but the one prior. And so since then, you know, here's the track record of what the S&P 500 returns over month, 3 month, 6 month, 12 month basis following those. And sorry, was there a question?
Yes, Wes, I had a question.
Okay.
While this Zweig breadth thrust happened on the 31st, it turns out that the same advances to total, it went down from 0.8 to 0.3 over the next 2 trading days. So it almost looks like it negated it immediately.
It's let me just step in. It's occasionally, I mean, the signal is what the signal is.
Yes.
And so the signal, I mean, this has only happened just a half a dozen times. Well, when it's maybe 15 or 20 times over the past 70 years. So the signal is what the signal is. And
Sure.
and Wes is going to probably bring up the slide on the Walter Deemer buy signal, which also that's happened, I think, only 25 times since World War II. So this is just really anecdotal. And when the Walter Deemer buy signal flashed, I mean, we immediately rode over a couple of days later. And that's really sort of the environment that we've been in. Every time that the market has been overbought, we've rode over. But typically, this happens at the beginning of major moves in new bull markets. That's why we're illustrating it here.
Okay, thank you. Thank you for
You're
the
welcome.
context.
Sure.
Thank you for the question. Yeah. And so just to see where we are, we have these average performances again over those time periods. And so we're it's been 10 days since that. So we're still about flat. So, on average and looking at the median, you see that the 1 and 3 month periods can be pretty positive. And then also looking out to 12 months, very positive. So, when you think about what a typical 12-month period in the S&P 500 is, it's maybe 10% on average, looking way back, for an average return. And so this is significantly better than the average returns there. And we'll look at this chart which I think kind of demonstrates better, visually better when they occur in the market cycle and what you can see historically following those. And again, looking at this, it's just it's been, I think, pretty timely. You can look at a couple of instances where it's not, but it's something important to, I think, take note of, because we've been so beaten down for such a long period of time that this is just, every little instance of this kind of happening where you have lots of stocks improving is a positive, and it's in the right direction of getting into the next real bull market. Okay, and then like we talked about the Deemer signal from last month or 2 months ago, this is just a review of that. We're going to send out these slides later so you can take a look at these data points, and this has happened a little bit more frequently than what Zweig has come up with, but really, similar results, but since it's happened more, it's not, I guess, not quite as positive on an average basis. So the Marty Zweig is being a little bit more selective in those signals. But please take a look, review this. As you can see, we're still at the 3-month basis right here. Since that signaled on January 12th, we've kind of lagged behind the average return you might expect from the S&P 500 following that.
And Wes, point out after the pandemic signal. So, the market bottomed in March 20th, 2020, and this signal flashed, a few months after that. Yes,
it did. That's right. And right. So what was interesting about this one is how quickly it really occurred too, right? From the bottom. If you're looking at the NASDAQ, which we know bottomed December 28th, this happened just 2 weeks after that. But you're right. So you didn't really get into that easy dollar environment in 2020 until June, early June, right? The bottom March 20th. Then we had a follow through day, maybe April 6th or something, which should have told you to get a little bit exposed. And then by June, early June, you were really getting you really needed to step on the gas, you realized, because of the overwhelming participation. And so speaking of the participation, right, we're getting, it's somewhat of a mixed signal because of we're getting this thrust indicator stuff happening with all these stocks allegedly participating. But then I just wanted to point out this advanced decline line and this divergence that we're seeing. So, you know, when the market's making a new high, which didn't quite happen here, right, between February and April, but nearly, you know, touched the same exact level as February 2nd, I believe that was. You'd like to see the advanced decline line, you know, this measure of breadth, confirm that move or meet that move at least, right, in the very least, and you haven't seen that whatsoever. So what we'll notice too, if you do the math, I did the math, and because some people were quoting how I guess top heavy this index performance was, right? There's only a handful of names that are really that really drove this last move in the market for over the last month. Ever since that banking crisis bottom, it's been a very narrow market. You saw people flying into these mega cap tech names that were supposedly safer. So you're just not, you're seeing these thrust indicators, which are definitely a positive sign, but you haven't quite seen that participation in trend change for a lot of individual stocks either. So, we're going to want to see that that change for us to get aggressive, or, I think in any of us to really get aggressive, we're going to have to see much more participation. You're going to want to see stocks in uptrends. You're going to want to see stocks above their 50-day moving averages, just to signify being in an uptrend. And so you can see, while there's been no real improvement in stocks above their 50-day, we only have 29% of stocks above their 50-day moving averages. We have had this pretty big reflex rally following the banking crisis. And these are kind of the weights these are the stocks that attributed most of the returns in the NASDAQ year to date. So year to date, I think I have S&P 500 here, but this is actually the NASDAQ composite return. That's 15% year to date, the NASDAQ. And so, 40% of those returns are from Apple and NVIDIA. And then 93% of those returns are from all of these stocks, right? The mega cap stocks. So, go ahead.
Wes, let me just make a point also that, and we'll talk about this recently, what's happened over the past, and this happened a few weeks ago. We had the bank contagion, and we'll talk about that. And the bank contagion occurred when, and a number of these banks blew up, and we'll show those imminently here. But because of all the quantitative easing and the free money, the printing of money, banks were flush with reserves, and they were investing these reserves and investing these deposits in longer term maturities. So they weren't matching their assets with their liabilities. And a lot of these bank stocks, they've come unglued, and many of the money sitter banks have also. There's been a flight to quality out of the regional banks to the money sitter banks, but the money sitter banks are getting hurt as well. And during this period of time, people just wanted cash flow. And if you're managing money on Wall Street and you must stay fully invested, you had to put your money somewhere. And so portfolio managers, clearly on a short-term basis, they went into these mega cap stocks. But this would not be, these stocks presently aren't CAN-SLIM candidates because most of them have declining earnings. They've got declining earnings. Earnings are going to be poor. They're warning. So it's not companies that are typically CAN-SLIM where you've got accelerating earnings, and earnings are growing 25% annually and 25% quarter over quarter. So, while this has been a great bounce, it's been a bounce in, based on contrary to what's actually happening in the market when you look at the broad market. But nevertheless, you have had a bounce here, and what's going to be interesting to see in the next few days when the quarters are reported, if they're going to disappoint, and they're going to come back down. So that's what we're certainly aware of, and you should be aware of that as well, that they have poor earnings prospects in these big cap stocks currently.
Mhm.
So a quick question, because I got to ask this since you brought that up. You think big banks could be running to like Microsoft? That's why Microsoft probably getting a jump like it don't have.
Well, Microsoft actually was downgraded by UBS today because they think that their Azure product, and that's their web management product, is going to not meet expectations. We're seeing all the big cap techs, they've downgraded their numbers. We just want to see if they're going to have to continue to downgrade their numbers. Keith McCullough, for example, from Hedgeye, believes that there's going to be a massive revaluation of earnings in these stocks, and that we're going to be in a significant recession, and that we're going to have another leg lower. So that's going to be, if we have another leg lower, that's going to be because we're in a more prolonged and more serious recession than people expect.
Oh, gotcha. Yeah, because I seen the downgrade today. True indeed.
Yeah.
But like before then, like Microsoft was just running. Like,
It was.
yeah, it
And
was.
then, and then of course Tesla has had a major move off the bottom, and they've cut their prices 3 times. So margins they're going the other way, but yet the stock has had a pretty good first quarter, despite their fundamentals being really, sketchy. It's tough to make heads or tails of that, actually.
Appreciate it. Thank you. Yeah, I was
Sure.
just asking. Thanks.
Sure.
Okay, so it's similar chart to look at. We're looking at the percent above the 200-day, similar non-confirmation. You're just not, like we already talked about, there's just another way to look at it based on the longer term moving averages. Okay, and so we know this is sort of, people seem to have short memories. This is still possibly happening in the background. These stocks have not rebounded. The regional banks, we know that there was the bank run that was kind of started at Silicon Valley Bank, moved over to Signature Bank also. So both of these have gone away, right? SIVB, SBNY. Credit Suisse was bought out, which isn't on here. But the other sort of suspects that people were concerned about are on here: First Republic, PacWest, Western Alliance, and then the regional banking index. So we've seen, this was just a month ago, right? I think it was just 30 days ago, but this still has to be in people's minds. It's unclear really if, what's going to end up happening with deposits. It appears that they've stabilized. If their tech companies continue to burn cash, and these profitless Silicon Valley tech banks or companies are, they're not profitable. They're burning through cash. They can't raise new money because of the market environment. It's possible that those just continue to shrink on their own through the quarters ahead, just because of that. And it's kind of, we are getting those mixed messages about how much is really insured. How much of your deposits will be insured, if it's only going to apply to systemically important banks, or if they'll extend coverage to all these other banks. But nothing's happened, nothing's come of it of late. It's just kind of bouncing along the bottom now the last 30 days. So at least we've added some stability here, and clearly the market's been okay with that, as long as it's not getting worse.
Wes, let me reflect on this just a moment for those that didn't trade in the great financial crisis in 2007 to 2009. And I remember this clearly, just like from the internet bubble from 2000 to 2002, we bottomed in 2003. And in the great financial crisis, if you remember, we had Bear Stearns. We had Bear Stearns or Lehman. They went under on March 16th, 2008. And then that was Lehman, I believe. Then Bear Stearns, bottomed in September. I think that was September 15th, 1998, months later. So the other shoe dropped, and we had about a 50% drawdown from those two periods of time. So what we're most concerned about is the flight out of these small and regional banks into money center banks, all these banks having to go under, and the Fed, the Treasury Department or the Fed, they haven't guaranteed all the deposits. I don't know why anyone would have deposits in, banks that can potentially go under, because what's happened here is all this money is flooding out of these regional banks, and they're putting them in treasury bond, T-bills where you can get 4. And it's affecting the lending ratio. So banks are having to contract their lending program. And that's going to there's going to be tremendous pressure on earnings moving forward. And, if some of these regional banks go under, the Fed's going to have to come back and insure all the banks in the whole country. And they clearly haven't said that. But that would really be a potential worst case next leg down that can potentially occur. And that is very much possible in play. So you've got to be prepared for that. You would never buy any of these stocks as investments thinking that these companies are attractive. They went out, Silicon Valley Bank went from 100 to 0 in one day. And it went from 360 to 0 in the course of 3 or 4 days. So you never buy these stocks thinking that they're great banks. They're in dire financial straits. So don't, for goodness sake, don't bottom fish thinking that these are attractive.
That's right. And to the other, I guess, layer that you could consider with these regional banks is, even if their deposits are stable, you have to think about earnings risk with them because of possibly that higher deposit rate. They have to pay their depositors now to attract and maintain that level of capital that they need. So that's not going to be good for them, right? If they have to pay a 4% on their savings rate to their depositors. So it's something to consider. And like Roy just mentioned about thinking there's a value play here. You saw Credit Suisse, right? You saw the offers come in on that Sunday afternoon, I think, where it was mentioned that UBS offered, a 75% or 90% discount to the closing price on Friday. So that's certainly a risk too, as they continue to, I'm sure they're having talks with a bunch of large institutions about a buyout and trying to see if they can come to an agreement. And that's still out there, that First Republic Bank could ultimately get bought for $10 out of nowhere, but something to think about. Okay, and here's a look at the S&P 500 index. We marked just a few things like that we just talked about, right? The key moments that we're considering throughout this presentation so far. That breakaway momentum gap on January 12th. With the Marty's Wide Thrust on the 31st here, and then this is peak banking crisis mode right here this Friday, and then this Monday following the Fed intervention, where we bottomed since then and rallied for the last month or so. Okay, and so we wanted to go over a little bit more about more context about what we've experienced in this IBD style, can slim style of stock, and just look at the longest history we could find really for the IBD 50 index on marketsmith.com. And you can see that how much we've given back over the last year and a half in this index, right? So this style has clearly been out of favor, and we've come in 50%, which is a massive drawdown in this kind of index. And you can see the best environments that you're going to see are when we are making new highs, and there's no overhead, and there's just everything's working. That's the easy dollar environment we're really looking for. Obviously, with this much overhead, we're gonna we're gonna start to see traction in this thing before we're making new highs, but it's just a telling history of what we've experienced, this historic drawdown. And you don't want to abandon the strategy, as long as you've limited your drawdown to some extent. This is why we're all here, month after month, and why some of us sit in front of our screens day after day, trying to find the next big winners.
And Wes, let me make a point here as well. Guys, when you look at this is going back looking at the last, I think, around the last 15 years or so. And this is really from that November top in 2021. This is the most, this is the largest drop we've ever had in 15 years in the last year and a half. And you can see there's the pandemic low. There's the pandemic low in 2020. And, if the indexes are the individual stocks are going to do twice the indexes. As you see that the index dropped 50%, you saw like Kathy Wood's stocks dropped 80%. You had many stocks that were prior leaders like Teladoc and Zoom that dropped 90%. So we want to encourage you here, because we're encouraged as well when this market turns and you get traction. And when the index comes back and makes new highs in the next couple of years, you're going to have stocks that do twice that. So you're going to have these great leading stocks that are breaking out to new highs that are going to go up 2 to 3 to 4-fold. You're going to have some of those. And what we're trying to do is identify those while the market's while it's slumbering here. And, we'll in the second half of the program, we'll talk about at least 30 stocks that can be potential new market leaders. So, just remember that there's a time for everything. There's a time for this style to work, CanSlim to work. And, for stocks like Google and Netflix and Amazon and Priceline and Tesla, the new ones to emerge. And so you're not going to, those stocks have gotten bounces, but by no means are those stocks can double or triple, in a brief period of time. We think that their goose is cooked on the long-term basis, while other stocks are going to emerge. So keep that in mind and keep screening stocks, keep a look at your new high list, keep screening for earnings acceleration, and we will identify some of these winners.
Right. Yeah. And I mentioned overhead, but just a reminder about this IBD 50 index. There's a lot of turnover in it, so the composition is changing constantly. And the stocks that we're going to talk about later are all near new highs, right? There's some bottoming paces that we feel like we've attempted to purchase, but really we do want to see stocks at new highs that are going to move the most in earnest.
And I'll make one more point just for you, so that you guys will know. We have 9 stocks, and we're about 25% invested in stocks, and that's it. And we want to be 100%. We'd like to be on margin, but the environment hasn't been conducive. This 85 index, and this is the weekly review from the newspaper, and it's stocks that have 85 earnings per share rank and a relative strength rank of 85 within 15% of a 52-week high. This is one of our favorite screens that we've used over the last 15 years. And you can see that we're in the midst of this correction. And, this has been in a downtrend. And it's trying to bottom. We need it for it to bottom and improve and turn before you'll start to see many stocks populate the new high list.
Great. And so I wanted to bring up the CPI. This is happening or being released. The March numbers being released tomorrow morning, 8:30 a.m. And this is, we have the historical CPI table right here. And then, basically the consensus is for a 0.3% sequential change in the CPI in March. So this is looking at year over year, however. So I just extrapolated what if the CPI grew at the consensus 0.3% month over month for 4 straight months, just to demonstrate that we have these comps changing. I think this is interesting because since the market really has been focused so much on CPI, if we can see this meaningful type of deceleration purely based on the comps that we're going to be facing, based on how hot inflation was in June of last year, it's naturally just going to come down on a year-over-year basis this June. So it's going to be meaningful, I think, the deceleration, and it's going to be interesting to see how the market kind of digests that information and sees, right, if by May we're meaningfully, with the CPI is meaningfully below where the Fed funds rate is, I'm sure there's going to be a lot of discussion about how much longer they need to keep it at wherever they are, 5%, 5.25%. So just keep this in mind. We should not be surprised to see meaningful, I guess, improvement in the CPI on a year-to-year basis over the next several months.
And let me make the point too on interest rates, guys. So the narrative out there, here we go. The narrative is that if interest rates drop and the Fed has to cut, that's good. Well, in some cases, that is in fact it is good, and it has been positive. But in 2008, in the midst of the great financial crisis, in 2002, in the midst of the internet bubble, the Fed was cutting interest rates because the economy was in a recession, and that was bad. And so the market just came unglued. So the narrative on TV, the Fed is going to cut interest rates. Well, if they cut interest rates, stuff bad is breaking in the economy. So it's not necessarily good. A more positive outcome would be in like 1994, 1995, where the Fed pauses. So all the Fed needs to do is pause, and then we'll just see what happens with the market in terms of momentum and institutions buying, and it turns into a nice uptrend. But right now we're just rotating from one group to the next. So don't think just because interest rates are going lower, in a recession they go much lower, and the stock market historically needs to go down another 10% from the lows. If we have a serious recession, from a valuation perspective, your downside in the market is 3,000. It's 3,000 to 3,300, and we're at 4,100. So you have significant downside if we embark on a serious recession. So you always have to keep that in the back of your mind from a macro view.
Hey, this is Faraz. I just have a general question. What do you think about Mark Minervini's tweet regarding likelihood of a pullback, potentially a significant pullback, given the IBD 50 the IBD 50 has still not broken out of its base below the 200-day moving average. Then you're also having a decreasing in the 50-day moving average and 200-day moving average percentage of stocks in the NASDAQ since February.
Well, we're fans, and we're also subscribers to Minervini Service. He's friends of ours, and we do know him, and he hasn't been able to get any traction whatsoever this year. I mean, he's been chopped up just the way anyone else has been chopped up that adhere to rules and taking, just cutting your losses short or small. So I do know that he is keeping it very, very small. And, he reminds us on a daily basis that it's the market environment that we're in. And, we're in this, we're still really in this bear market. And, David Ryan today, I heard him speak, and, he thinks that we might have, a couple more weeks of upside. It's going to be fueled by the CPI report tomorrow. And then he believes that we're going to roll over. We're just looking at the individual. You just have to look at the individual stocks now and sort of disassociate yourself, with the indexes. And again, the IBD, we wouldn't buy the IBD, the FFTY, but it's just a barometer to show you if you're in phase, if growth is in phase or not. I think that's the most valuable thing to know there, is that if the FFTY is turning and it's going up, you're going to have all these other factors fall into place. You can have new highs expand, and you can have more stocks on your screens. There are very few stocks that are hitting our screens from the way that we screen stocks currently.
Hey, Roy, can I ask a
Yes.
question?
Sure.
Yeah, so I thank you for sharing all these details. I hear you loud and clear that there's a possibility for a strong pullback, but every pullback opportunity, it just beats up with a higher volume on the most equities. How do you explain that? Do you have any thoughts on that, please? Thank you.
Run that by me one more time. I didn't quite get it. Every
So
pullback.
even like, if you look at any, not necessarily intraday, right? But every, few days, if there is any pullback in a stock market, right? The buyer just come in and they coming with a stronger desire to buy. So
Well, we haven't seen really a lot of institutional support because the percentage of stocks above their moving averages haven't moved. So I think we have only one distribution day on the NASDAQ right now, and the market is trying to make a transition. It's trying to make a transition, and but the last place that members have hid were these large cap tech stocks, and these large cap tech stocks have very poor earnings projections. And no, stocks typically bottom in recessions when you do have negative earnings. But that's what we don't know, is we don't know how bad the earnings are going to be, how much unemployment needs to rise, and how slow the economy is going to transition because of the bank contagion. All these things are things that we don't have the answer to. And so we don't know, we just don't know yet. But you'll see more stocks, you'll see more IBD stocks that pop up to new highs. And when that happens, that's going to tell you that the transition is occurring. And, at that time, you definitely want to be off the averages, because the averages aren't going to go up 200 to 300%. And you'll be able to find stocks like Teladoc and Zoom and Peloton and Livongo and all these stocks that from 2020, you're going to have a duplication of that scenario, that backdrop, but they're going to be totally new names.
thank you.
You're welcome.
Okay, so let's see. So the next slide we've been looking at these Fed funds futures a little bit the last year also. And so this is the projected Fed funds rate over the next several meetings. And this is from the CME group. And basically I thought this was interesting too, because 1 month ago on around March 10th or so, that's when we were at the peak of this panic, because regional banks were all going to go under. And so you can see that the market expected rate cuts like immediately. And so they were saying by the summer we'd be at 4.25% or so. And since then, over the last 30 days, this Fed funds futures curve has creeped up to this black line, and this is back to exactly where it was basically before there was any banking, potential banking crisis out there. And so what's interesting is we're still ending up at the same exact point at 3.6% for the Fed funds rate over the next what's about a little over a year from now. But the path is quite different, where it's just higher for longer. So back to what the Fed has been saying all along, is higher for longer, higher for longer. and just interesting that we can, we've so quickly priced out cuts because it, as far as the market knows, the banking crisis and contagion has been contained. And Chris, I know you asked about the yield curve. It's in the back of our mind. It's important, right? It's been this sort of leading recessionary indicator. The problem with it as like an indicator and trading with it is just the fact that it could be many years before an actual recession
This
even
is
occurs.
Larry.
But
I've got a question
hey, Larry.
back on the last slide.
Yeah,
Yeah, that's really interesting news. I was listening to CNBC today, and they said that the influence of the banking contagion that we had could result in between 1/4 and 3/4 of a point taken off the peak interest rate. Have you heard anything about that? Right? You have any thoughts on that?
yeah, we've heard about it, and I think Jerome Powell himself said it as well. I don't know how anyone can quantify it, so I guess I'm sure some expert or guru put a quantity as far as how much this tightening of credit conditions and banks failing could mean. What's it equivalent to, right? It's hard. Obviously, it's very hard to figure out what that really would be. But I've heard that. I don't know. That might be right, and that maybe the Fed pauses because of that. It was going to be a difficult. It's. I don't really know how much it is going to be an impact. But definitely, I mean, that would be the expectation, and so the Fed doesn't know either. They're just going to have to monitor it, right? It seemed like they would have just initially upon all this bank panic, I assumed that they would just stop raising rates, but I guess with their tools that they injected all this liquidity into the market already, just to stop all the panic. They just felt that they could continue to raise rates because obviously they're stuck in a bit of a rock and a hard place with wanting to make sure inflation comes down, but while also maintaining stability of the system. I'm sure that it is going to have some impact, though, absolutely. And so I guess that's the concern over the next 3 months is how bad does that flow through the system? And like Roy mentioned a second ago, is when we start cutting, if it's because we're in a horrible recession, the banks are stopped lending, and there's just no liquidity out there, then that's not necessarily the positive. That's not necessarily a positive development for the market initially.
And I'll make another point, Larry. When we had the contagion a couple of weeks ago, and what the Fed did is they opened the discount window. And by opening the discount window, this is really an emergency measure where they opened it for all the institutions where you could borrow at par, at $100 at par, all the bonds that you had underwater, you could borrow and you could use it for collateral purposes. And it wasn't just a couple of banks. We had more money that came into the discount window than the great financial crisis. And that happened in a week. We had more money that was acquired by banks. So this was clearly a systemic issue. Of course, they're going to, not Congress, but Powell and the Fed and the Treasury, they're going to jawbone this because they don't want panic to ensue. But that's not positive, and that's not like quantitative easing. They've been taking money off of their balance sheet for the last couple of years, and 70% of that moved back on the balance sheet in the course of a few days. So that's why you have to be aware, and we're very aware that another shoe may drop. It may drop, but the Fed just gave this lending apparatus 1 year. There's a 1 year moratorium for you to be able to use your bonds as collateral. They just kicked the can down the road. A year from now, they're going to, depending on where interest rates are, they're going to still have, billions of dollars in losses that they're going to have to realize down the road, particularly when they have to pay the Fed back. So that's just something, that may have, things could get more rocky, things could get worse than you thought, just like what happened with Lehman and Bear Stearns in 2008. You thought that it was, that was over 2 years, and you thought that the majority was over, and then the last shoe dropped. And this, like Wes said, the Fed's between a rock and a hard place, and we have to be prepared for that next, that potential shoe drop.
Roy, don't you think that they have the ability to continue to raise rates, stick with their saying that they're going higher for longer, because it was almost like quantitative easing? It may not be the exact same thing, but it's very similar.
We think rates have peaked, and by looking at, and the Feds can probably raise rates 25 more basis points. And in the past, you want to see Fed funds be lower. You want to see Fed funds be lower than the than the inflation rate. And so you're going to have you want Fed funds to be higher than the inflation rate, and that's coming down. And so, we think within a month or so, you're going to, your Fed funds is going to be, below the bond rate. And that's in that case, the last 7 times that's happened, the Fed was done. So we think that the Fed is definitely almost done, because this stuff hasn't worked through the economy yet. So we don't think that the Fed's going to continue to raise rates much higher, maybe 25 basis points, but rates are coming down even though the Fed is raising interest rates. I think the 10-year bond is at 3.4 today, and it peaked at 4.3 as the Fed continued to raise rates. So that's because market expectations are telling you that rates are going lower.
Okay, thanks.
You're welcome.
Okay. So with this, I don't have much to add on it. Yes, we've been talking a little bit about the inverted recession or inverted yield curve and recession signal, what that would mean. And so, it's been inverted for, I don't know, a year now, and we haven't technically had that recession based on the BEA. But you can see we've never been this inverted again since the 1980s. So this is the bond market sniffing out something. It's also sniffing out lower inflation. So keep that in mind, right? This is a whole situation where a lot of what it's pricing is simply inflation coming down, but it could also be pricing in that recession, or signaling that we're going to be in a recession at some point. So here's the S&P 500. It looked a little dicey, right, about a month ago, in the middle of March, where all the averages were kind of crossing over. We were below the 50 to 200 day, and now just 1 month later, this quick rally, and really the trend has improved dramatically over that time. All the averages. And so here's the NASDAQ and the MACD. So we saw that kind of trend line break, which was back in the middle of March, shortly following all that bank contagion issues. We saw the MACD turn to a buy signal also shortly after that. And then the move has continued in a pretty orderly manner, with a nice quiet pullback so far these last 5 or 6 days. The MACD is not overbought here. We saw it get overbought back in February, and then subsequently roll and lead the price decline. So right here, if anything, we're not seeing the momentum continue. That would be kind of a negative divergence with the indexes popping up towards new highs or new recent highs, but the MACD not able to continue. But for now, nothing wrong, right? Nothing wrong with the NASDAQ indexes other than the narrowness, like we've already talked about. But when you look at the indexes, things are in a short-term, medium-term, I'd say intermediate-term uptrends. We're still not necessarily in a long-term uptrend. We're still making lower highs if you look back from November, but a lot of improvement in just trend direction. And so if the index, it doesn't help, it doesn't hurt to have the indexes at your back, right? We want to see the indexes making new highs and working, and hopefully just add wind to your sails for individual stocks. Okay, here's just a closer look at the NASDAQ and the moving average crossovers. Our primary, I guess, short-term trend that we care about is when the green line is above the magenta line, the 10-day is above the 21-day. So we've seen all that. The 50-day has now been upward sloping for some time since the start of the year. The 200-day also notably has turned upward. So at the end of March is when that started to improve. That's also another development, positive development. And all this stuff has happened in spite of everything everyone already knows, which is the bank issues, which were quickly squashed, the recession fears, the inverted yield curve that's been looming for many, many months. So you can't argue with it, right? You can't argue with the trend, and that's why we're continuing to get incrementally exposed and just continuing to trade small because these breakouts aren't really working. But here we have clear improvement in trend over the last month.
And Wes, back up 1 second. And for you guys that want to go and take a historical look, when the market peaked, and so we've talked about the Deemer breadth thrust. We talked about the Zweig indicator. Back at this peak in February, right there, we went into a power trend, and Mike Webster has done a lot of work from when he was with IBD O'Neill as a portfolio manager. And I went back and looked at the power trends since 1949, and we had the Dow then, and back then, and then also the latest power trends in, the last 2 decades. And in this particular case, the power trend is very, very positive, but that's when it hit. And power trend, you've got to have 10 days where you're the 10 days above the 21-day for 10 straight days. The 50 days got to be in an uptrend. The 21 days got to be above the 50-day. And that you actually had a power trend, and that signifies a launch of a new major uptrend. And that occurred back in February, right at the top, right when that was the top. Now, according to my calculations, now we're in a power trend now, where we're the 10 days above the 21-day. It began right there around the 20th, right there where Wesley is counting. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So that right there, see that we were in the power trend right there at the top exactly again. So will history repeat itself? It's going to, that's going to be, I think this week is going to be an important week for additional strength in the market, broadening out in the market, or the market rolling over based on the inflation news, CPI tomorrow, PPI Thursday, and retail sales. When you have event-driven, huge event-driven and news-driven variables, you can't go into events like that highly exposed. And it would be reckless to have, to be fully invested right when you have this if bad economic news comes over and you totally turn down, because these growth stocks can pull down 5 to 6 to 7% in a day. So it's time to be cautiously optimistic, but let the data and let the trend and let the market guide you in the next few days.
Okay, so let's continue. We have the NASDAQ and the 30-week moving average as our kind of our long-term trend indicator. We need 2 consecutive closes above the 30-week moving average to really be in this longer term, put us in this longer term uptrend. And have not had 2 below since that occurred and at the start of this year, despite this kind of tough pullback to endure, especially if you were in individual stocks and you did chase to start the month of February. You were most likely kicked out, but so far the trend has still stayed positive. We've still stayed above this 30-week moving average and continues. And this is interesting. I mean, seeing this tighten up over the last 2 weeks potentially too is a great thing. Just lower volatility that we've seen the last couple of weeks. Okay, and this is one of our favorite indicators to know when you're really in a good money-making environment. When we're going to start getting aggressive is, and when we can start getting aggressive is when this is overwhelmingly positive. This is the net new highs on the bottom. So when we're red, we have more new lows, more stocks making new lows versus new highs. If we're blue, we're seeing those new highs outpace new lows. And then these are the inputs. So this is the high number. We saw, for instance, February 2nd, we saw 200 stocks making new highs. And we saw very, very few stocks making new lows. But for the majority of the last year and a half or so, we've seen just new lows outpace new highs. And it's really hard to make money in stocks on the long side in this particular environment. We're seeing some improvement, some drying up of new lows over the last month, ever since the banking situation. We've seen that new low number improve. We saw this is right here, this new high number coincided, this pickup in new highs coincided with the Zweig thrust signal that we talked about as well. And so we're still not there, but at least we're seeing the drying up of the lows, and we're seeing the net number come down a little bit. And possibly flip positive if we get, if we do get some positive economic news, and we may see that environment improve. And just looking longer term, we have the net new high number, net new low number here on the bottom, just to give another sense. Since November, we've had the lows outpacing the highs. So we're coming up on 18 months of that environment, and so that's just meant being careful. Being very selective. Really, we've had to buy pullbacks instead of buying breakouts. Every breakout has really been just like feels like bait to get long and then be sold into immediately. You really haven't been able to trust any breakouts. Very, very few have been working, and so this has been a very, very, very prolonged period of that. Okay, and this is one of the oscillators we prefer when we're thinking about if we're overbought or oversold. We were overbought at the end of March, again with the Zweig thrust, with all these stocks advancing. Overbought based on this McClellan oscillator as well. So far, we're working through that overbought condition. It has not been very violent. It's actually been a pretty good pullback, pretty tame pullback. And that's exactly what you want to see from these overbought conditions if we're going to have this move sustained. Okay, and then the VIX, saw the VIX spike to above 30. We're back here at this 18-19 level. We've revisited this 18 level a few times over the course of this bear market. We've broken that 20 number a bunch, and it's yet to be seen, I guess, if we have any more spikes. But if we're gonna, this is where we want to be. We want to really be we want to live sub 20 for sure in this bull in the next bull market. but for now, we have not really sustainably been able to see that breakdown in volatility. Different things keep happening, but and Keith McCall will tell you that he's undefeated, or the VIX is undefeated if you short it when the VIX is at 18. If you short the market when the VIX goes to 18, but at some point that's going to stop, and we're going to have a lower volatility environment when individual stocks won't shake you out, won't buck you off like a horse. But when we've been thinking that we might see that spike in the VIX, right? That's what we've been talking about for the last year and a half too. Have not really seen a huge spike. We've seen it close to 40, I guess, early on in 2022, but not a lot. I think, we may not get that, right? We may not get the spike, and we just want to see, when this move, we want to see a declining level of volatility, just like we saw throughout this 2020 and 2021 market rally. Okay. And so I think we hinted at, this is one of the indicators we look at as well for sentiment, market sentiment. This is the active net assets, active investment managers index. So it'll tell you, it's a survey of institutional managers and how long exposed they are in the current market. So right now, this survey of managers is about 73% long. And so we've seen that get as low as 10% at market bottoms, and it's somewhat of, it can be that you can use it as that contrarian indicator here, but there's still plenty of upside. It's not like active managers are lever long by any means, like they were by the end of 2020. So there's, it's still a cautious environment. There's still not a lot of bullishness out there, and no one's really willing to get that exposed in this market. So I would say right here at the 70% level, it's almost like it almost tells you nothing, because you're not either way, right? You want to look for extremes, I think, in this market more so than, or in this indicator, than anything else. All right, and right here we have the bulls and bears. This is the AAII Bull Bear Sentiment Survey, and this is of individual investors. And so we saw bears outpacing the bulls quite a bit naturally about a month ago, right? When it was very unclear what was going to become of all these banking things, and people were all worried about where their money, was their money safe wherever it was being held. And so just since then, it's just, the more nothing happens, I guess, the better, right? No news is good news as far as that goes. And so we've seen the bearishness drop off actually pretty quickly over those 2 weeks, and bullishness pick up again. And if you look at the net number, this is looking at the bulls minus the bears. We're about dead even with the bulls and the bears, and haven't seen this since, which I guess this was maybe February of this year. That's probably when that must have been February 2nd or so, right? That first week of February when stocks were rocking to start the year, and we saw bulls outpace the bears. But it's been, again, a very, very prolonged environment of this bearishness. And I think just to be even is totally fine, right? You can absolutely have a bull market when bullishness is it's even with bearishness. And you can see in 2020, near the end of it in 2021, we still had this market rally, even with bulls outpacing the bears. So yeah, again, just pretty even battle right now for the bulls and bears where we're at. Okay, and then looking at the put call ratio, another sentiment indicator we're looking at every day. Again, I don't know if there's much to say here about this either. It's not complacent, it's not overly pessimistic where it is right now. So nothing, I don't know, no extreme to really note here. We haven't been complacent for a very long time on this indicator, right? So nothing to signal that, I guess, a major top or anything at this point. Okay. And we got a few more here. We got the high yield spread, so a measure of credit risk, something that we take a look at. Also, if the the bull market continues, we're gonna want to see this at least stabilize, possibly start coming down. But it's a measure of credit risk, and you saw credit risk increase, pretty aggressively over that short period of time in March. Again, with the banking issues and everything here, and since then, just with these credit spreads coming in a little bit, basically saying, okay, the market is starting to believe that the Fed has it under control. And for now, it appears that it does. So, we can't argue with that. We can't argue. It's hard. We won't know better than anyone the real credit risk out there, so this is our best barometer of that. Okay, and there's a few more slides on rates which we can take a look at, but the 2-year, I think really the key thing, I've added this in here just to make that note. I think last month we had the 2-year versus the Fed funds rate, and just showing that the 2-year leads the Fed funds rate, right? The 2 years, the markets is the market saying where they expect the Fed funds rate to be over the next 2 years, essentially, right? So we know that the Fed funds rate now is at I think 4.75 to 5, so right around here, this level. So right here with this 2-year breaking really sharply below that Fed funds rate, it's saying they do expect cuts. The market absolutely is saying the Fed is going to need to cut. They may not be cutting next month or the month after, but within the next 2 years, they're going to cut, and they're going to cut a lot. And you can see that, based on the Fed funds futures, the market's saying that we'll be at about 3.5% in the next year or so with the Fed funds rate. Okay, and meanwhile, this 10-year yield peaked back in October of last year. This is really why we're interested in those longer term treasury bonds, like we talked about, the ETFs, IEF, TLH, and TLT, from least duration to most duration. Those are the kind of best BlackRock U.S. Treasury bond ETFs. And
Wes, show right where we went long here, and we were talking about this, guys, in the last meeting, but
yeah.
we think there's more upside still in bonds. We're just looking for a more attractive place to put them on. They're right where Wes is pointing. That's where we entered in the 5 to 7 year, and
it was the 7 to 10 and the 20 plus. Yeah.
Right there. Right there, that's right when we were thinking the market was peaking. You recheck the high up there at 40.91, and we had the break. That's where we put it on, and we think that before this is over, you'll potentially have another 1% drop over the next year here. And if that does happen, then it's a win-win. If we're in a recession, it happens. If we have a slowdown, it happens. If the Fed lowers rates, it happens. So this is a win-win in just about every scenario. It's a matter of putting it on, and how much exposure do you want? Do you want? So we think there's another point down here from 3.4 to 2.5 in the next year, and if that's the case, these bonds are going to appreciate 15 to 20%.
Right, and definitely, because even like you said, I think it's a really good win-win for situations. CPI comes down with no recession, or we have a recession and CPI comes down, then they work better. So it seemed like a very good opportunity. The tough part was just not calling the top, but finding the right price to get big in these. And not that 15% is very big, but it's different, considering we don't really want to be in bonds. We prefer equities that have 50 to 100% upside, but this is just it's we think a good.
So if the inflation news is really bad, I'll just make that point, and you get a move back up to 3.6 to 3.7, And if you don't have any bond exposure, that's the place to put it on
Yeah.
to add to your exposure. And, you know,
Yeah.
if the number's friendly tomorrow, well, you know, rates are going, you know, you're going to see this go lower. But, you know, if there's one more scare, we do think inflation's peaked and rates have peaked, and you get one bit of information, you know, one bit of economic information that scares the market, I think you can put bonds back on if bonds rise tomorrow and the next day.
Yep. And this is the last slide here. Just had to throw this in because you can't ignore the actions in Bitcoin. This definitely, I mean, this looks like it's in a stage 2, right? Uptrend. It looks like this is signaling bull market, right? This looks just the overwhelming volume of, you know, blue volume and price action, and we're up. I mean, you've almost doubled off the bottom, and it's acting like you want to see your growth stocks act, right? When you have this kind of tight consolidation and another breakout and follow through the next day, and it's just, you know, something that I think needs to be highlighted, because it definitely looks like the bottom should be in on this, and you know, don't forget about it. Keep it on your list. All right.
And Wes, drop the link for if you guys, if you're not on our email list, Wes is going to drop the link and where you can sign up. And what we're going to do right now, let's just take a 5-minute break. Take a 5-minute break, and the meeting officially will conclude at 9 p.m. But we're going to stay on longer. But we'll stay on longer until you guys get tired of talking about stocks. But what we're going to do, I'm going to show you 30 stocks that should be right now on the top of your watch and buy list. So I'm going to give you 30 ideas that you need to do some homework on and be prepared to purchase if your analysis reflects that. So let's take a 5-minute break. We'll get started in 5 more minutes.
Hey, Roy.
Yeah, hey, Amy.
Hi, how are you?
I'm doing great. Hope you're doing well.
I am, thank you. Hey, this is kind of off topic from stocks, but what do you think about what's going on with the US currency and how they're saying that could become like the secondary currency to, what is it, China's? What are your thoughts on that?
You know, anything could happen. You know, obviously China's trying to maneuver themselves to, you know, they really are playing the long trade here, and you know, they're doing everything that they can to disrupt our economy, to disrupt our power, to disrupt, you know, our influence in the world scene. But I don't think a communist government would ever, I don't think the yuan is going to ever be, you know, from a communist government would ever be the legitimate world, you know, currency out there, the standard. So I don't think there's a chance of that happening, but you know, there's a chance that, you know, if our account, you know, if depending on what happens with our situation politically and economically, I mean, you know, bad things could happen, and that would be reflected on our currency. But remember that, you know, our economy is much better than in Japan and Germany and, you know, in all the developing countries. So I don't think, and I don't think Bitcoin will usurp that either. So, I mean, I think it's just going to be in a trading range, Amy.
Okay, thanks. Yeah, there's been a lot of talk about that, like among my friends and stuff like that. And you keep seeing segments about that on the news, and it's just kind of scary. And what you're saying about China infiltrating so
Yeah.
many different sectors of our economy, it's just getting really kind of concerning and somewhat scary.
It is concerning, and particularly, what would be concerning is, if they take over or attempt to take over Taiwan, which we all expect that to happen. We do expect that to be, that's been out there for a long time, a black swan event, and that would not be positive at all. But just look at the Russia Ukraine situation. We've kind of put it back of mind. It was from America's perspective, and that just shows you how isolated we are as a society.
I agree. All right. Well, thanks for sharing thoughts. I appreciate it.
You're welcome.
Hey, Roy, this Chris again.
Hey, Chris,
Hey.
I knew it was you.
In your ever in your career, have you ever seen a period to going on not similar with the inverted yield curve? Inverted yield curve, it's been so long that it's been inverted. NASDAQ up like nearly 16 to 17% year to date. Have you ever seen anything like that that's similar?
No, I haven't. In fact, and it's it would be, but we've seen so much that's really unusual since the pandemic. Just the great unwind. It's potentially the mother of all bubbles, which is deflating here. And we could say that if we make a next, if things get worse and we make a next leg lower, but the market will tell us, and your individual stocks will tell you that too. But we looked at that inverted yield curve. So remember, the National Bureau of Economic Research, they're the group that's responsible for saying we're in a recession. And they're saying that we're not in a recession now, but all in the past, through all the recessions, the stock market bottomed in the middle of a recession. And if we're not in a recession now, that means that we do have more downside potential. At least that's been in the case in every single case in the past. So it would be unusual for us to be in a recession and the stock market to be higher, unless we're in a recession now and it's discounting that.
Right. Cause what's strange is, like, I've been trading for 7 years now.
Okay.
What's strange is cut production the other day. It goes up like 6-7%.
You cut out on me, Chris.
Can you hear me?
What was your question again? You cut out on me. I'm sorry.
Can you hear me?
Don't hear you.
Hello?
Yes, I hear you now, Chris.
Oh, you hear me now? Okay. Oh,
Yeah.
What I was saying was, Samsung had cut production.
Yeah.
I would think would be bad news, but Micron goes up 6-7%. That news.
Yeah. So just look at exactly. And Micron missed their estimates by billions of dollars, and the stock went up. So
Exactly.
that might be telling you that it's discounted, and that's the same thing with NVIDIA. So these stocks had horrible guidance, and yet the stocks bottomed and went up. But these stocks were down a huge amount as well. So perhaps it's just a reflex bounce as well.
That's what I don't know what to think. It almost, cause Micron on the guidance basically missed twice.
Yes, they did. Yes. They did.
So it's like they kind of tell me a bottom end. They go off 7% off the Samsung news, which should have been more bad news for them. I would thought they'd go down 10%, but that goes up.
Sure, yeah.
7.5%.
And that's telling
I'm
you,
gonna turn the bullish.
that also tells you that you've got to follow the trend, not what the news is saying. It's how the stock reacts after the earnings, not necessarily what the earnings is, but how does the stock react after earnings? Okay, guys, let's go ahead and get started on the second half of the program. Again, we'll go through these fairly quickly, but I wanted to, do you see my screen here? I've got 30 items here for the IBD meetup. This is on MarketSmith. Do you guys see this? Just
Yes, we do.
You do? Okay, you can take a screenshot of this, and this is a screen that I ran that has to do with earnings, relative strength, and so forth. But they're potential leading stocks, and I want to just go through these quickly and just highlight these, and then we'll go through any stock that you want to that you want to talk about. But these are stocks that have high relative strength. They typically have strong sales or earnings growth. They're dominant in what they do. And these are potential new leading stocks that can double or triple from here. And, we're constantly refreshing our database, but we own 9 of these stocks of this group in 30. And we're always monitoring and refreshing this list, but I gave you 30 names that you could take a look at. And the first is ALGM. You can see that we're using the program MarketSmith. You can see the earnings growth down here at the bottom, and then the earnings growth 84% last quarter, revenue growth 33%. It fits that profile of 25%. Earnings are going to be up 63% this year. It's a great market cap. It's 8.6 billion. We really don't look at PEs. So O'Neill, from all the work that he did, PEs were never important, and if you never bought a stock that had a PE, you would have never been in Amazon or Google or companies like that, because their PEs were astronomical in their primary growth state. So you can see you've got a 98 relative strength, and I've got a horizontal trend line. That's really where the stock broke out there in February. And now the stock's basing. So it's going to be interesting to see if this is the first time that a stock after it breaks out and pulls back to the 50-day, it's typically buyable. So, take a look at this company. They're primarily in the automobile and EV and the industrial market in that semiconductor group. The number 1 rated group right now is the electronic semiconductor group. So, this is so follow, take a look at this, do some homework on this one. Now, ANET is they're in the internet data center business. Now, Microsoft was downgraded today by UBS, and Microsoft was off. It was off. This is a stock that's similarly in that business, and they do have an AI component in their network. And you can see the stock's got tremendous earnings and revenues. And I'm going to show you, these are the CanSlim stocks. These are the stocks that aren't just going to bounce 10%. These are the stocks that can go from 100 to 200 to 200 to 400 over the next 8 earnings cycles. And, it's a fairly large company, $48 billion. It's an institutional favorite. And it had an inside day today. And you can see as the stock technically sets up, it's right at the 21-day. A recover of yesterday's high on volume tomorrow would be something that you'd want to watch out for. I put the alert wrong way there. And that's something that you can watch out for tomorrow to see if you can take out yesterday's high and resume the uptrend. Earnings are due in 20 days. Great numbers. in the networking group. The networking group is 28. You want to keep most of your buys in the top 40 industry groups. Those are really where your leaders are. And notice you can see most of these stocks are near their 52-week highs. So they're not like, they're not like they're not like most of the FANG stocks that are still way down from their 52-week highs. These are the potential new leading stocks. This AVAV, and Joseph Ebeth mentioned this a couple of days ago. It hit my screen as well. And this is a company that's in the drone business. So you might imagine that drones are extremely popular right now, and they'll continue to be so. And there's the breakout, the upgrade on volume. And I believe they signed a new contract with the government. So it's got a 98 relative strength. Notice the relative strength line is going into new high territory. And it was going into new high territory right before the stock made a 52-week high. And something that Wesley and I have been looking at, we've been looking at the all-time highs as well. You don't have far to go until you make a new all-time high in the stock. And that's when the stocks really, of course, get going. The next stock is Taser. It's funny. I was just watching. I was watching earlier today. The cops that were involved in the shooting for the school kids, where 6 people were killed, and we were monitoring. And that was released today. The cops were showing their Taser body camera. And that was, once you make this transition to using their product, that's a very sticky application. And you can see the stocks, got robust earnings growth, 52% last quarter. Revenues were up 54%, 98 relative strength. And you can see that it made it, you can see where the stock made an all-time high right there. And look at that on the monthly. So this is going sideways for 2 years. So you have a 2-year base. And when these things get into new high territory, look at when the stock was in the IPO phase. This stock went from 2 to looks like about $70, 35-fold in the next 2 years once it got into all-time high territory. And this actually is very similar to sort of the gold chart. Double verify, you can see a number of these IPOs, and there are a couple that have our attention. I've drawn a monthly downtrend line, and this company is in the advertising market. They signed a deal with Netflix to monitor all their advertising so that they could optimize it versus their sales product. And notice this downtrend line. You're breaking the downtrend line right now. After came out, was a hot IPO, corrected dramatically, and now the stock's broken that downtrend line. And I was looking at this with Wes. And CrowdStrike, see, look, now remember this chart, remember this pattern. See when CrowdStrike broke the downtrend line right there after the bear market. It was a hot IPO, corrected from 80 to 40, and then it came back and broke that downtrend line. So that DV might be in a similar type pattern in terms of duration and also the magnitude of the drop and the move up. And look what happened to CrowdStrike. It moved from 70 to 270, up 4-fold in the next 2 years. So DV's got that type of chart pattern as well, as does IAS that you'll see a moment ago, that we'll see momentarily. Five Below stores, retail discount store, not in a great group, but the stock is acting well. So it's got a 95 relative strength. This is a blue dot rating. So there's some criteria in which the stock is it the relative strength line is a new high, plus other criteria for it to have this relative strength blue dot. And you can see it just broke out to, is that? Yeah, so that's getting close to all-time highs as well. And see, remember that, remember that the great new stocks are going, most of them are going to be in all-time high territory because there's no overhead. And that's what you want to that we're spending a lot of time focusing on these companies. If we would have bought this stock yesterday, but we just didn't want to take more exposure into, the event. But it broke out. If you were sitting here watching the stock, you see you had the pivot. There's the pivot right there at 209.78. So you could have bought it at 209.79 right there, and the stock followed through to the upside. If the stock pulls back and sets up a new base and rechecks the breakout point, I think it definitely is potentially viable. Earnings are out of the way, so you don't have to worry about earnings for a while until June. The next stock, this is a really, I think, attractive position, shift for payments. And they're in a number of ballparks, venues, and they have they've got a full allocation of payment services from their terminals to the payment process, and they're among the latest. The stock had an IPO here a couple of years ago. Notice this. See, this is another look. If you draw this trend line right here, see what I'm getting at? See where it broke that down trend line just a couple of months ago. And so, if it's a new leader, you're going to see the stock take out 100 and go to 200 over the next couple of years. The stock was upgraded today by a Wall Street firm with an $85 target. And so the stock was up nicely, and you can see, and we have a position in the stock, of course, and we probably pressed the position at 73.62, probably right there when it took out its high. We added a little more, and we'd like to have a 5% position, and I think our position is like 3% now. But look at the earnings growth. Earnings were up 488%. Revenues up 35%, 45%, 44%, 68%. See, we're trying to identify the stocks. You just need one of these. You need one of these, and we would like to have 10% in 10 stocks that have the potential to double, triple, quadruple over the next year and a half. And this is where they come. This is how they emerge. We're deep in this bear market. You have very little leadership, and you're constantly just trying to see, well, who's holding up in a bad market? And ideally what you want to see is the FANG stocks come in tomorrow, but these stocks hold up. And you can differentiate between the true market leaders and just the index stocks during periods like this. And that's really what we're focusing on, and where we think you need to be focusing on. But the stocks that make new highs in this market environment, those are the potential new leaders. And, remember, O'Neill is looking for 25% earnings and revenue growth. We're looking for triple digit numbers. That's what we would like to see. First Solar, most of you know about First Solar, and they're sold out for the next 2 years. And look at the earnings growth on First Solar. It's got some of the most attractive fundamentals that you can see. You can see earnings are going to be $6. They're going from flat last year to $6.86 in 2023 to $13, up 100%. That's 89% next year. So you have accelerating earnings, accelerating revenue growth, great $22 billion market cap, an institutional favorite. And you got, look, 1,600 funds that own this stock. It's got the highest relative strength ranking. And you've got, there's Fidelity Contra Fund right there, one of the top A+ rated stocks. And you can see, look, this is the last earnings report. See, this is what got your attention right there on the earnings report. It had a 10% day in price, volumes up 300%, a 10,300. And what you want to see is you've got this slight inside day today. And this is one that we're actually monitoring tomorrow. We don't own, but we're close to adding it if it would take out that high. And, great future, great business. We do wonder how the business is going to be if there's a recession, but they do have that Inflation Reduction Act that they're benefiting over the next year, that they have tremendous tax credits that Congress allowed them to have with the Inflation Reduction Act. And you can see the stocks acting great and in a nice uptrend with the strongest relative strength. This is a bottoming formation, Fastly. This was a big winner in the past. You can see it got up. We traded this a few years ago, back in 2020, made a lot of money. And this is one of those bottoming bases. So it's not one that's making new highs, but what got my attention is the earnings, the revenue, the breakout here, trading 12 million shares right there. And on the earnings report, it got up to $17. It pulled back. And now taking out that 17.18, taking out that, and you can see there's accumulation today on it as well. So this is a bottoming base. It was upgraded today from a firm on Wall Street with a $26 target. So it stocks at 16. It's got a Wall Street target of 26, and it's one of these that's beaten up. It does have a 98 relative strength, but there's your pivot right there at 17.18, which is only what 30 cents away. And like Wes reminded you, a lot of these breakouts have been failing, but this is something you should definitely have on your watch list. Some of these work, where they come some of them come, they are going to come back and reassert themselves. Most don't, but a few do. And Fortinet's yeah.
Well, there was I think maybe an interesting question in the chat. Why bother buying something like First Solar that on a breakout when we've, the breakouts really have not worked largely, right, for the last year?
Because at some point they're going to, the environment, when you see that they're working, you're going to know. And see, there's the breakout right there, and it worked. There's the breakout, and we didn't buy it on that breakout. We were probably indecisive about the market, but you want to pay attention to volume and price. And I'm going to show you, I'll show you LNTH. And it was a breakout based on price and volume and expectation breaker that was positive. But you're right, a number of these stocks that are less quality, they haven't worked, but this is the one that worked. So this is one that you should have bought it on the open, and then you could have added to it. You could have averaged up on the pullback, and then you could buy more taking that level out. So you have, you can do this in stages. So in a great environment, the breakouts are going to work. When they start working, these stocks are going to be up 20%. Like that, we missed this ALGM. That was the first stock that broke out on our list. And when you're looking at thousands of stocks, it's tough to get that. But look at that breakout. See, that breakout worked. So, that was a $35 price where it broke out, moved higher, and now it gave you one shakeout day. Now it's pulling back. Again, this should be potentially bought at the 50-day when, the stocks that come back to the 50-day the first time and the 50-day is higher than the breakout is a positive situation. Fortinet is in the security area. You really have a couple of these Palo Alto Networks is on our list as well, but Fortinet, that has continued to have exceptional earnings and revenue growth despite the bear market. But look at the period of time. You haven't made any money. This thing went from 71, all the way down to 45. But there's the signature change right here. Traded 19 million shares. And often I look at that. I examine the stocks that are up 10% in price and volumes up 300%. Joseph Beth, he features these many times when he finds some on Twitter, so I would definitely follow him as well. And he identifies a great number of these. So stocks acting great, great revenues, great earnings. We've heard our government talk about we want to move our semiconductor firms from China and Taiwan to America. And this is the premier play on that. Global Foundries is a $10 billion a year revenue business, market cap of 36 billion. Earnings were up 700% last quarter. They're a beneficiary of bringing business back to America. Got great numbers. This group is in rank number 18. So it's in the top 40. Expectations earnings are going to be up 38% next year. Most people haven't heard of this company. And look, here's your idea. You can see where I have this trend line drawn, this horizontal trend line, where you take out this momentary lapse where it spiked, and this is after the IPO. And occasionally they do this. DoorDash did this, ran up and then closed at the bottom. But you can see that this stock has been building its base, and now it's close to going in, taking out the first month of its high. And so this is where you can potentially have a new leader as well. We own this stock as well. So great numbers. You want to see it hold the 50-day. And for the question in the queue, we found that not only have breakouts failed, but many stocks you've been getting kicked out. You've been getting kicked out of stocks that are, from 8 to 10. We're trying to hold them to 10% with smaller positions like 2 to 3%. But you can see where Global Foundries, if you bought, this is a perfect example. And thank you for that question. See if you bought that breakout, taking out 68.47, right there, it failed immediately. And so, stock dropped from 70 to 50, 35% or so, and then it turned up. And, typically you're buying stocks, we want to buy stocks that are above their 50-day normally, and where the 10 days above the 21-day, and the stock's in an uptrend. But here's one, if you bought it perfectly at the breakout, you took your 8 or 10% loss and moved on down the road. And we bought this probably at some point over the last month. We're probably up in it 5 to 7% or so, but we want to average up in this position. 95 relative strength. And you want to see this breakout now work. So right there, taking that pivot out, that'd be technically a buy. Taking out 72.50 a little higher, add a little bit more, as you work your way into the position. And, and in a good, if this market turns, you can see this $70 stock turn into a $100 stock, over the next 3 to 4 months, over the next earnings period. If the earnings are good, it's going to gap up. It's going to gap and go. Gold is very interesting. This is our friend John Roque, who was on our call a few months ago. He's been talking about these Brobdingnagian bases, and these are bases that are like many years old, like 15, 20 years, 10 to 20 year bases, and gold is finally getting back in gear. And so we're close to, we don't own it, but there's the sort of the breakout there at 181. And it's going to be interesting to see what happens over subsequent days. And that's going to depend on what the interest rates are doing and what the dollar is doing as well. But a breakout to all-time highs would be tasty indeed. Taking this out right there, I'm taking that out. I'm sure we'll put a position on. We'll just see how it acts in the next couple of weeks. But notice here, notice back in 2005, when that GLD went from 50 to $1.80, over the next 3 years. That's the next 5 years. So you got a 300% move. And it going back into the 70s, you actually had a much bigger move in it. So it's breaking out. If the stock's coming out of it, that would be a 3-year base. So that would be attractive. HubSpot, you can see I have the downtrend line drawn. Big IPO. They're in primarily in the marketing field, where they do everything for you. For a company, they do everything from mass mailings to capturing leads to providing content, following up on that. They're the best in the business in what they do. I forget the term, not input marketing. I forget what the term is.
Right. I mean, would you not say CRM or something? Aren't they just CRM?
They have a CRM module as well, but I'm trying to think of the marketing term where you're not contacting the customer. The customer is
inbound.
It's inbound marketing. So they're masters in inbound marketing, and that's a big area. You can see, look at the institutional coverage. 1,400 mutual funds are in it. You have many. There's T. Rowe Price. You've got, these are the top rated. These are the A+ rated funds right here, based on the IBD mutual fund index. Now, these funds on average were down 34% last year. So the A+ rated funds for the last 1, 3, 5, and 10 years were down. Over, some of them were down 40% last year, and they've got a big presence. When you have this many funds, they're doing the research. They're telling you, there's your seal of approval right there. I mean, you've got everybody buying this and in it. And the stock's down from 866 to 400, down 50%. And what I like about it is it reacted. See, there's the earnings report right there. And so taking all this out, earnings are in 29 days, taking that out, there's the pivot, the blue pivot, would indicate the resumption of the uptrend. So, earnings are out. I probably wouldn't buy it before the earnings, but if this stock gaps up and volumes up 50% higher than normal, taking that pivot out, that would be an acceptable, bottoming base in a stage 2 up. It's now in a stage 2 uptrend. Look, it's just tremendous numbers the last 2 quarters. So this is when we're supposedly contracting, but they're still doing quite a bit of business. And again, I urge you to look at the monthly and look at the weekly charts. A lot of these, when you look at them on the weekly, and they don't look so bad. You know, they look like, okay, it finally bottomed. Now it's not going crazy, but now it's in an uptrend. And, you know, all you want, right, is all you're looking for is a move like that, 60 to 600. You know, so this is these are the types of stocks and companies you're not going to make 20%. You're going to make multiples if you find the right leading stocks. And that's what we're trying to identify here, is trying to get the leading stocks. I would think a company like this, in fact, with the institutional ownership and the numbers, would potentially come and make new highs at some point in the next year and continue to grow. Okay, IAS, and we just have a few more names, and then we'll turn it over to you guys. That guy, this is an advertising company. There's the downtrend line. There's the signature that's telling you that, okay, buying is off the bottom. I don't know a lot about this company, but earnings are going to be up 500% this year. And it's in that, advertising space where you're getting rid of cable and moving to streaming. And you can see it's now in a stage 2 uptrend. Last earnings, and this is what you're looking for. The reaction was up 30% on the earnings report. And no one knows who this company is yet. IoT, Internet of Things. There's the earnings report. Stock reacted great to the earnings. It's pulled back. You can see it broke this downtrend line, and earnings are 6.2. So technically speaking, if, from a trading perspective, you could add the position taking out that pivot, that would be a legitimate buy. You got this nice little base, and you could round it out at 2150. And they've got an interesting business model. You can find it out at samsara.com. You can study the business, but that would launch, taking these prices out would launch a new resumption of the uptrend. So 97 relative strength. Iridium is a satellite company, and they're using Qualcomm chips so that you can message anywhere in the world on your phone, and they'll charge a fee for that, and that's going to open the business up to potentially the globe, millions and millions of customers. And they revealed their partnership with Qualcomm on the earnings date. It's been going sideways. Earnings are in 9 days. I don't think I'd get in front of this before the number, in 9 days, but it is consolidating. And the next earnings report is going to tell you the next move, which the next is going to break out to the upside or the downside. But have that on your watch list. We've talked about Lantheus forever, and this is a stock that we own and got stopped out of here, or here. I can't exactly remember when, but the stock was making 52-week highs, and they make an imaging agent for prostate cancer that's the best on the market, that's being widely adopted. And it had these numbers, triple-digit numbers, and we couldn't understand why the stock was correcting with these numbers. Look at the numbers, up 900%, up 700%, up 900%. These are the stocks that you get multi-baggers in. These are the stocks that turn in to be Pelotons and Zooms and Teledocs. This was one of the top stocks, this summer that we were looking at, going into new high territory while the averages were correcting. But this just shows you that it wasn't the stock, it was just the time in the market. And this is where it launched on the earnings report. And so there's the earnings report, and it gapped above the 200-day, which is important from a momentum perspective. Stocks that are below the 200-day that go back above the 200-day are typically buys. So they're, they've been in downtrends. Now they're in an uptrend. And, you just have to, it's an art, it's an art identifying, these companies. And this is one of our largest positions. And it's just about to break out to all, I think, is that all-time highs? Yeah, see, all-time highs. And we've been talking about this stock for, a long time as well. And there it is on the weekly. See, on the weekly, I mean, it doesn't look bad at all. So it's just a matter of perspective and, how much exposure you have, how much of this you get chopped up in. But you can't let a stock go from 80 to 50. You can't let it drop, almost 50%. You have to cut your loss at some point. And in the current environment, we've been like trying to hold on for taking 10% losses. In a good environment, we'd cut that to 3 to 5%. And Lululemon, and this shows you sort of what's going on in the market. Everybody knows this company, but look at where the stock was making a 52-week high. Then it got crushed on their earnings report. And then it's gone sideways and down. This is the kind of market, guys, we've been in. And now look, this is the earnings report. Now it gapped up on big volume. They gave great guidance. You've got great sponsorship here. Look, 2,000 firms that own it. So this stock technically should be bought, taking that out. This base right there, it's big institutional company. Look at this. This isn't far from a 52-week high. This is a great institutional stock. It hasn't done anything. Look at this for 3 years. See, look at that that's the 2020 top. So, but when you see this go through that resistance of the 2020 and then that all-time top, you got something to work on. This, you can get a move like this. You look at this move from 2000 to 2017 bottom, 60 to 400. 60 to 400. You only one of these and it changes your life. Meli is a Latin American payment company, got great numbers, and earnings were up 450%. I'm showing you the best of the best of the best that Wes and I have found. And I mean, we own this. This is our biggest position, and we would get bigger in it, taking out really this, but we're limiting our positions to 5% currently. Look at the earnings growth, and they're in the processing payment area, retail internet, in Latin America. And, 97 relative strength with great earnings, 400%, 30, 70, 290%. Next Trader, it's an IPO, earnings up 260%, stocks close to breaking out. Look at the revenue growth, 50%, 38%. So it's they're in the same business as Shoals and ARRY. This is our favorite position, ON Holding, of course, the shoe company, and it broke out on earnings. And this is a bottoming base where it finally goes into its stage 2 uptrend. And their shoes are quite popular. New company, the stocks got a 97 relative strength, a $30 stock that can go to 100. And with good quarters, and good numbers, they've got great institutional sponsorship. Fidelity's in there. This is exactly what you want to see on a new emerging growth stock, and it was an IPO. And let's take a look at that. Do you see the theme, guys? See this theme? that's where, like that, like CrowdStrike, that's what, from these bottoming bases, some of these are going to be great performers. So they're not at 52-week highs, but this is the pattern, so they've gotten through the correction and they're resuming their ownership. This is still in the institutional due diligence phase. And, this is where you can get some tremendous winners. PagerDuty, earnings are out of the way. That's earnings, bottoming base. And look at the blue, look at the volume, the breakout right there on high volume, the breakout on earnings on high volume, and it's above the 50-day. It's in an uptrend and stage 2 uptrend. Earnings are going to be up 900% this year. Impinj, a semiconductor stock, earnings up 150%, 900%. This is sloppy. We do own it, but it's real sloppy. I wouldn't be surprised if we get kicked out. But if it takes out all this resistance at 145, then it's game on. So it doesn't look bad there on the monthly. And then the weekly, same kind of thing. So we'd like to see this hold. Great relative strength, 98. Insulet is an insulin, not an insulin company, a continuous it's like a continuous monitoring system for diabetes. And the earnings are great. Institutional company. It's a great, see, don't think that these stocks can't go to 1,000. This is a $300 stock that can go to 1,000. And look, this is what's got our attention. Look, it's gone sideways for 2 years and it's about to break out. See, when these stocks go sideways, guys, look at that. This stock went sideways for 4 years and then broke out. And then you got the massive move. It's gone sideways for 2 years. And that'll be an all-time high territory. That's what's got our attention. And you can see it's got very robust numbers to it. Rambus, Shockwave. I'm gonna wrap this up. But this is what I was talking about that LNTH. See, this happened today. And we got kicked out of this stock. And look at how this breakout failed right there. See where the breakout failed in October? It was the market, not the stock, but its stock dropped from 300 to almost 50%. But there's the catalyst, see, and they bought another company and earnings were, look at the triple digit numbers. So just take a look at this. This could be, this could be like that LNTH when LNTH broke out with the big volume. And, so this is one of these that it's winking at you right there. And Transmedics is a organ delivery company, new company. See, no one's heard of this, but look at this. And look, this is at all-time highs. And this is what's got our attention. So I'll pull back here, it's viable. And you've got Fidelity in here as well. You can see Fidelity and Vesco, they're in this stock. And it's not a novel technology. Instead of having the organs being delivered in ice, they're actually in vessels that recreate the organ, and they circulate warm blood through the organs. There's Uber, and there's the earnings report, great earnings report, the best of their the company since inception. It's pulled back here. It is below the 50, gave great guidance. Wingstop they're going to add about 500 stores this year. And then WWE signed a merger agreement with UFC, and it broke out a few days ago. You had a shakeout, but the CEO of this company, so McMahon, he's still like, he's going to be co-CEO, but the Stemwinder is another gentleman that turned around the Ultimate Fighting Championship company. And that's generating, I think he's generating like $1 billion in earning or cash flow from that turnaround. So the partnership was well received, and really nobody's following this. And this is what's got our attention, is this is a 5-year breakout. See, and if this guy could do for WWE what he did for UFC, and they have great synergy there, this could be a big company, in the next few years as well. So that's all that I have. Those are the best ideas, guys. And I know I did all the talking there, but I wanted to give these to you so you could take a look, do your own work. But I guarantee you there are going to be a few of these. A few of these are going to double, maybe more than a few when the market environment is robust. So with that, I'll turn it back the floor over to you guys, and we'll go answer any questions or go through any stocks that you guys would like to cover.
Hey, Roy, it's Larry.
Hey, Larry.
I do have a question, because it seems like oil is ready to break out again. And with all the risk that you're putting out there for this current, all the optimism in these stocks, I'm still looking in other areas that are not, not this kind of opportunity. So I was looking at like Chevron or Exxon or Pioneer.
Yeah, who?
Like Chevron or Exxon or Pioneer, or any of these oil stocks, with the predictions of the oil going back up to 95 or more.
Well, that's the that's the problem, is we don't know where oil is going. And hold on one second, and let me just pull oil up on.
Yeah. And also with the OPEC cutting back on production, and that bouncing things up a little bit.
Let me see. Stop share. And let me pull up.
Same thing with commodities and so forth. You kind of mentioned that with gold, but I was also looking at like FCU or FCX with copper and gold and those kinds of companies, and just looking for alternatives until these guys really show their colors, that they seem to be opportunistic at this time, at least for me.
Let me pull up the futures. So right now the Nasdaq's up 4, the Nasdaq up 100, and remember, the dollar fits in there some as well. And let me take a look at here's oil. So this is oil on the annual basis.
Okay, you've got to share.
Let me share. Thank you, Larry.
Market Smith.
Thanks. Okay, do you see, this is FinViz?
Yep, you see it now.
Okay, great. Okay, there's oil. So, there's oil on the daily. It's in the steep downtrend, and we don't know where it's going here. I don't know if it goes to 90, 95. I mean, you had OPEC announce some production cuts, but let's take a look at the monthly. So here is the last 2 recessions, Larry. So that's what oil did.
Oh, interesting. Thank you.
See, and that's really, I don't know. I mean, if we're in a recession, then what's going to hit the fan. If we're in a recession and oil dropped from 140 all the way to 40 here on futures back here. Oh, and then look at this recession. Oil went to 0. This is the 2020, and it's showing here, but the futures in oil, the price dropped so much that we had negative. Remember that when it went to, it was negative. So you had to pay somebody to take your oil free. You know, and like, here, take as much as you want, just, we don't have a place to store it. And there was a futures imbalance there. And so that happened. And, you know, during that recession,
Yeah.
and, you know, that was a 2015 recession.
Tanker
Right there.
companies went nuts. Yeah.
Yeah. So that's really, but the big one, the big bad one is we're comparing this market. You know, we don't have I'd like to go back. I don't have we have it on stock charts. We could go back and get the 20-year on there's 2000. Okay. 2000, you came in there, but here's the big recession and oil, boom, got hit. That's what we're worried about.
Yeah.
And so we can't, and you know, here are all the, you know, what other, like copper, you were bullish on copper.
Mm-hmm.
Where's
FCX
copper?
is one of my favorites.
Okay, so let's take a look at copper. Where's copper? Silver, gold, copper. So there's copper.
Mm-hmm.
There's the bear market. You know, there's the downtrend for 6 years. You know, you got lower highs. You know, where's, you know, I have no idea where copper's going.
Right.
You know, if the economy slows down, you're going to have less needs for copper and steel and things like that. So here you've got a lower high. It suggests that it should be sold here, you know, with this bounce to a lower high, that, you know, it potentially should be sold.
Thanks for putting the perspective on there. But I know China is looking to consume a huge amount of gold.
And gold,
copper rather.
Copper, yeah. And let me see, what else do I have here? Cattle, palladium. This is what makes the market so difficult. This is when Russia invaded Ukraine. Right there. And then you would have thought, I'm guessing it was right there. This is, yeah, probably that. Yeah, right there. And then you had the recheck where the stock made a lower high, and you would think that, okay, that there's going to be a shortage in wheat, there's going to be a shortage in oil, and you would think that oil would have gone sky high. You would have thought natural gas would have gone sky high, and all those commodities peaked. So where do you buy this in a downtrend? You know, I would never buy it in a downtrend. I mean, yeah, clearly anything can bounce. You know, it could bounce from there to there, there to there. But, you know, this steep downtrend, it didn't do what you thought it would do. And that's what makes these commodities, you know, difficult to trade. So there's wheat. And, you know, the dollar, the market is in, you know, right now there's a inverse correlation with what the dollar is doing. So there's the dollar that went up. We peaked. All this, you know, printing of money, you would have thought it'd be you know, printing money, inflationary. And then, you know, the dollar peaked and the dollar's been coming down, you know, for the last, you know, 4 to 5 months. There's normally an inverse relationship with the US dollar and commodities, and also the S&P. So, you know, if the dollar rises here, rates go higher, you might see the correction resume in the downtrend. If the dollar takes out this low and interest rates go lower, you're going to, you know, potentially you can see the market rally.
Yeah.
So, you know, so Larry, you got a great point. There's no way, any style can work. You know, any style, it could be value, any style can work, you could do, but
my philosophy, I tend to just kind of invest or trade in what's working.
Yeah.
And I've done well with those before. I got out when the chart said to get out, and now it's I got back in again because they look like they kind of bottomed. And
yep. And for that matter, I pointed out I pointed out like a number of these bottoming stocks. So those that are coming in bottoming bases, that I pointed out tonight. For that that strategy not wanting to buy, at close to new highs, that represents an alternative, a strong alternative.
Yeah. Oh,
And that's why we picked a few of these out, because some of these are going to work. Some of these bottoming bases in growth that got hammered, they are going to work, but you just don't know. You don't know which ones.
we don't know nothing in this market.
No, and like I think Snowflake was down big today. We had
Yes.
like SNOW. Do you see my Market Smith screen or not? Do I need to
Yes.
reach? Okay. So this stock was down $9 today. A lot of institutional ownership, but the stock, it looks like it's bottomed, but the stock's down from 150 to 139 in a couple of days, and on big volume. So people love this stock, but the stock it's in that enterprise area, and I've heard a lot of rhetoric regarding the enterprise areas, what institutions are going to cut back. And I know Snowflake's also got a big business in the big banks. And so the big banks are cutting their spending back because, the Wachovias and Bank of Americas and all those, because slowing down their lending. They know there's going to be pressure on margins and profits and so forth. But PWLO, another past winner that's getting hit. Twilio made a 52-week low. Yeah.
Hey, Roy, can you check out DSGX, Descartes Systems? It's a long-term winner. It's a software company. If you look at the monthly, in the weekly and the monthly, both.
Oh, wow. Look at that.
Yeah.
Man, isn't it amazing?
Fundamentals are phenomenal too, by the way.
I don't know where I've been in the last 15 years to not see this stock.
No kidding.
I just can't, I think Domino's Pizza has a long-term chart like that.
Yeah.
But look at that. Where's the party gonna end? I have no idea, but obviously, man, you just need one of those in your career. And the problem is, a lot of these correct 50 to 60%. The Google did it, Amazon corrected, I think 90%. And and that's what here from this stock went from 8 to 2. And
How about that for a base? So, like, look at that.
Yeah.
Like a long-term base almost,
Look at that. And again, that's when it went into, 52-week high territory and off to the races.
Right.
A great long-term chart.
If you look at the fundamentals as well, they're quite impressive.
Earnings are up 55%, 3029. It's one of these 20% growers, it looks like, Brad.
Yeah, we covered it at Wolf. It wasn't my baby exactly, but it was one of our guys in the transportation group,
Mhm.
And so I know it's a high quality company, high quality management and everything too. And I guess they're all about acquiring little bits of business or of software to build into their software. And
So through acquisition, they grow through acquisition pretty much.
Yeah.
or- Yeah.
Yeah, I think that's a lot of it. I think that's a big part of it. And I know one of their bread and butter things apparently was like some kind of customs database, and just being one of two companies that can handle sort of like taxation or something between all like every country across the world or something, but
Hmm.
it's got wolf coverage, which I think is good. So at least that's usually positive to just have more coverage is in general positive.
It's got a really nice cup on the weekly. It looks like it's poised to move, in my opinion anyway. Looks nice accumulation.
Yeah. You know, this is guys, look at this. Look, this stock was tiny years ago. It's only doing 125 million in sales, you know, per quarter. So okay, you know, you can occasionally get something like, I mean, it was probably doing 5 million a quarter back here. You know, back here. So some of these, you know, so a lot of times they're under the radar until they get much bigger. And, you know, until the numbers get much bigger, because, you know, from a market cap, it's only 6.8 billion now. And, you know, many institutions can't buy something, you know, until it crosses 10 billion. But look at the growth. I mean, it probably just had this 20% growth for years.
Mhm.
And this is going back. Look over here. This is the weekly. So look, this is the last 2 years. Look at the earnings growth, 18, 24, 24. So the earnings stability on this company was really strong. And I mean, going back to 2017, look at the earnings per share, 31, 35, 40, 45, just up 10 to 15, 20% and that's compounded.
It's a steady grower for sure.
Yeah, for sure. Thanks for that, Brad.
Mhm. Another one that I'm watching is Schrodinger. It seems to be, it's kind of a bottom fisher, but SDGR. And if you look at that accumulation in the weekly there, it's really starting to, I mean, it's above the 200 day. The fundamentals are not quite the same, obviously, but it's more of a speculation. But if you look at I like the accumulation. I like the handle that it's starting to form. It's tight. It's trading very tight.
Yeah, it's just getting back over the 200 day.
Mhm.
So it's a biotech company, I believe.
I think it's a form of AI as well incorporated in that.
Yes, it's you know, speculative. You know, speculative.
It's definitely speculative. Yes.
I saw this. Yeah, I read about this TXG recently. TXG 10 times genomics. This is a biotech, you know, genomics, you know, measuring your DNA and all that. This is sort of a turnaround situation. And, you know, David Ryan is, you know, used to play these all the time, or talk about playing these all the time. I mean, for, you know, years and years. And he made a career of buying stocks, beating up stocks that doubled too off the low. And, you know, he wouldn't get interested in them until they doubled. So, you know, people are saying, well, it's already doubled, but it's the next double.
Right.
You know, it's the next double. See, this stock went from 25 to 50. Now it's on your screen. And now you're looking to go from 50 to 100. Now let's see if the stock goes from 50 to 100. So so occasionally I'll run that screen. What stocks are up the most off the bottom? And those are potential buy candidates, not sell candidates. It's like, well, something's going on. There's a turnaround, just like that CrowdStrike. And, you know, if you get the right one, you can get one of those that, you know, that turns into a multi-bagger.
Yeah.
Hey Roy, what about Duolingo? I don't think I saw you talk about that one.
Man, it looks great. You know, I guess you can't kiss all the babies, but there's you know, this is a really great action, superb action. And if this, look, this is what I mean. When I look at this, I mean, I'm definitely an optimist, but I'm a realist too, because we're in the middle of the worst bear market we've been in 15 years. And nobody could see that coming. I mean, we saw, not that it was going to be this bad, the devastation. And if we're in a new, like you turn the corner, and like all these winning stocks that we've sort of looked at in the past, this stock just got going a month ago. See, look, it's only been going up a month, and they're the leader, in language education online, and apparently their apps are great. This is the best app out there to learn a foreign language. And there's the earnings. And if they're going to grow, if they're going to continue to be dominant, and they probably will, they'll continue to, have other apps and expand their services. This stock has only gone up 1 month. And the average, true market, not the average, but true market leaders go up about eight straight quarters, and that's 13 weeks. So I guess that's 94 weeks. And this stock's going up for 4 weeks. So if it go looking back in the next couple of years, if it goes up that much, I mean, you're going to have, this is a multi bagger that's only going up, and they're, going back, that's what you hate to look at when you see the catalyst. There's the 10-300 to tell you, okay, to get in, you're now in a stage 2 uptrend. You've only gone from there to there. And if this turns into a true market leader, this stock's can be a $500 to $600, $700 stock when all is said and done. And they're same. Look at there, Joseph. Let me put it on the monthly. See, the same kind of, that's what's got my attention. See this bottoming. Now the pause, so it's got this signature that I've reflected on often tonight about, okay, there's the 52-week winner, the all-time high. We're in the due diligence phase. You undercut the IPO prices. You got washed out. Now this last month, it just got going. So, these things go up for months, the market's got to cooperate. So this is one to certainly have on your watch list to see if it holds here at the 21-day. And, if the market kind of rolls over, it could even pull back to the 50-day there. But I think it definitely deserves to be in that top 30, Joseph.
Hey, Roy.
Yes.
Hey,
Mike.
Hey, how's it going, man?
Good to hear you.
Yes. BLDR was one that's been gathering dust on my 5th watch list, and it looks great. Pretty hot. I don't know. It waiting for the right pullback a little bit, maybe, but
it's one of these, man. I've been watching it as well, Mike. It's new highs, and actually going back, when you go back right there, finally took out the high in 2020. Boy, that's not much of a pullback.
no.
That's not much. I mean, that's a strong stock. It's in a good group, and 96 relative strength. What I don't like is look at the earnings drop over here on the left part of the scale, $10 to $18. Now the estimates for the next 2 years, estimates this year down 66%.
Okay.
So that would be,
That makes 125 sound better or something.
So earnings dropped from $5 to $3 in the last quarter. So it's sequentially decelerating.
I'm looking. Still looking at Duolingo, excuse me.
Okay. So that's a big difference in terms of the earnings probably, but
Let's call it 85.
yeah. So the earnings are, the earnings are decelerating, but the action's really good. I'm watching it go up.
Roy, Carl here.
Hey, Carl.
Two questions for you. You mentioned a fellow on Twitter, Joseph. I did not get the last name.
Ebeth, EBNETH.
EBNETH. Thank you so much. Also, could you have a look at O'Reilly?
Yeah. This is one of those long-term winners going back years and years. My sister knew this gentleman. And their company's in Springfield, Missouri. And yeah, this is one of those. Wow. I mean, just look at that. That's a life changer.
Do you think it still has potential in it, or?
I have no idea. I mean, it's earnings 10%, it moves like that. I mean, it's can go there without me.
Right.
And the earnings, they're not, the earnings aren't powerful. And that's what worries me is when these finally turn over, and it's a defensive stock. Let me see, there's Domino's. What's that look like? See, there's Domino's on the monthly. And it's funny, Domino's is outperformed like Google and, Google and Meta and all these companies, Domino's, and you would have, you wouldn't have known that. So, and now it's rolling over. So it wouldn't be, I don't, after you just never know when these stocks peak, but
Okay.
10% growth is just not
enough for you. I understand.
yeah.
No, I think.
Yes. Troy.
Sorry.
Hey, Roy, let me know what your thoughts is on this. IWO, right? That's pretty much how my trading's been going this year. Like January was great, and then it's kind of been treacherous since then. Kind of choppy, and then you got everyone piling into the NASDAQ. So it's been outperforming, right? Everyone's kind of in the mega caps. So kind of my thinking is tomorrow on this report, if it's like a true market catalyst, if it's a good report, my thinking is, names in the IWO, you got like, I think Shockwaves in it, and, all the kind of stocks we trade at LNTH should catch up to the NASDAQ performance wise if the market has a good reaction and we start heading up. And kind of my opposite thinking is if the market has a really bad reaction to the report, that it might even be time to maybe short the NASDAQ because everyone's hiding out there, and that the NASDAQ's going to have to revert to the mean.
Yeah.
Catch up with the IWO. That makes sense.
Well, clearly, and think about it's so disturbing when you're, and it's humbling when you've been doing this so much, so long, and you can't get that buy at the bottom, like the December bottom, and you didn't buy Tesla or
NVIDIA.
NVIDIA. That's the one. You just needed those two stocks. But, for 7 stocks, it moved the market up after looking at thousands. And then 2 stocks, Microsoft and Apple, that moved that was 40% of the NASDAQ move, just 2 stocks. How do you pick those 2? When those were the 2 that moved that had the biggest influence on the index. So that's why you have to have this breadth increase. I mean, you got to have new highs, new lows. It's got to be, new highs have to dwarf new lows. You need to be, at least, 100, 200, 300, 400, 500, 600, 700 new highs versus new lows. And the new highs today I can't remember what the number was, but it was probably, I don't know, 50. So you're not, it's the time, again, I showed a number of stocks where we got kicked out of. Man, we got the right stocks. It's just, man, it's the market because they're coming back. And so you won't, when the trend changes, everything's going to be in alignment. And then that's when you're going to make money, and it's going to be so easy to do. It's, but we've had to certainly bide our time and take this,
Yeah, I mean, right now it's like one day the Nasdaq's, the mega caps are up. The next day, they're going down, or the small caps are going down, and the Dow stocks are going up. It's just like a chop fest. Like, you can't even hold a name. Maybe, like, personally, me, I haven't been able to hold a name since January for like more than like 2 or 3 days, honestly. Like,
me too. Me too. Personally, let me see. I want to take a look at something real quick.
Like, even ON, I bought it the day after its earnings. Like, I bought the follow through after the earnings day.
Yeah.
And it came back in. And I think there was like it was the Fed meeting day, right? So it came back in because all the volatility. It didn't get back to my entry price, but I didn't want to hold it overnight because of the whole Fed thing. Because sometimes the market follows through to the downside, the next day, so then I sell it. And then of course it just rips after that higher. So it's like one of those things.
For sure. Price phase down. See, Wes pointed this out. See, this is the cues. See, you're in this little nascent uptrend. That's when we had the bank crisis right down here at the bottom, and we got kicked out of some stocks right there, just because we're breaking down, where's it going to go? We don't know how bad this is going to get. That's a very poor action right there. And, you don't know if you can break the 50 and go down another, 10%, but we held right there. But notice this MACD. So it's showing you that momentum right now is waning. And, something that, so if this stochastic turns down, I think the next 2 days, I think, are important. And you can see this SKSD. This is a derivation of fast and slow stochastics. You can see where this looks like it's somewhat cresting, correct? Where it potentially is cresting. So we could turn down right here. You get a sell here, just like you had back over here. And then you have more downside. And so we're right. I mean, tomorrow and the next day is going to be important. But that's why, and you've got this price phase that's turning over. This is the first down day after that high 2 days ago. So that's telling you the momentum is potentially waning here. It's not sell yet, but the potential is potentially waning in the next 2 days are going to dictate what happens. Now, what you want to see is you want to see money come out of the Qs. And look, you got a sell signal on the Qs today. See, I just looked at this. You got a sell signal on the MACD on the Qs today. That price phase, you made a lower high today. That suggests to me like we might have some weakness. It's all going to be what happens with this market, with the CPI and the news. But it's suggesting we had this rally off the bottom, we got shaken out, and the technicals, MACD, that's telling you we could have some weakness right here. And then again, if if the 10-day crosses the 21-day, that's going to shift from this small uptrend back to market under pressure.
Yeah, it just feels like we have so many conflicting signals right now. It's like
you want to see this. You want to see stuff come out of these names and hold in those stocks that we've talked about. like the ONONs, Joseph.
Yeah.
You know, you want to see this stock, and maybe it goes to the 21 day, but you know, it's above the 10-day right now. And it's kind of sloppy now. You had the big break on the downgrade. You had somebody downgrade it, and then it bounced back up. This is my biggest position, and we're just you got the cross open the MACD, and you want to see how these react. We didn't talk about Mobileye. There's Mobileye. It breaks out at this 45. That's important right here. I don't own this right now, but their lockup ends in April, maybe a week or so. So normally stocks that end their lockup, there's some additional selling, and there might be a secondary coming as well. But you take out 45, and this stock could go new IPO. The latest IPO that came, the latest big one that came, last year. And institute money managers are looking for new merchandise. You get into, you can see it's right about to break this downtrend line. So this might be viable. If we have a good number, you could buy this stock, taking out today's high, press it, taking out 45, and then you're off to the races. That's the way that you would handle a setup like that, if you wanted to partake.
You mentioned First Solar earlier, and I forgot to mention this one to you, that I'm sure you have it on your radar, that Max N.
Yeah.
It's like one of those younger solar names too.
And there's the earnings report right there. We tried SEDG, we tried Enphase, we tried Array, SHLS, and basically it's down to NXT and First Solar. There's NXT and then First Solar.
First Solar, I was just thinking, because I had a huge gap up already, and I saw that gap, and I was like, man, is this a viable gap again? Because I already had one, and I just didn't pull the trigger for whatever reason.
We didn't either. And now we're definitely looking at it to see again, if you take out yesterday's high tomorrow, it potentially move. It's been consolidating. It's one that's not extended. It's not way, it's going sideways for, 6 weeks. It does have a base. Just checking the chart, the messages.
I really do like the way that shockwave's shaping up. That looks like a cup, like maybe like a cup developing from the high to the right side of a cup, maybe.
Again, if it comes in, Joseph, if it doesn't follow through. If it comes in, that first 15 minutes, and then takes out the high, it would potentially be viable. You played those before.
Yeah.
I don't know where that line comes from right there. But if it comes in and then potentially goes.
Did you try to buy the AI ticker AI throughout the base?
Not for our clients, but I bought it personally and sold it on the gap down. Sold it pre-market. I sold it at 32 right there.
And that one was a doozy.
So this was, I mean, so I bought it right there. See where this breaking this trend line right there.
Yeah.
So it was a 20% trade in a day.
That's perfect.
And I sold it pre-market on the Hindenburg report. Sold it at 32 at 9:22 that morning. But it was too speculative, they don't, too speculative.
Yeah.
For anything other than, I mean, it was a trade, this for me, it was a 3-day trade, getting kicked out. But I'm really not, not SOUN and all those, passing on all that stuff.
Yeah.
But this is, guys, this is going to be a huge, it's going to be a huge area. This, artificial intelligence and chat GPT. We don't know who the real winners are going to be. And it's, we do know NVIDIA is right there, SMCI is in that area. They've got great numbers.
A lot of these AI companies are private still too, so maybe we get some new IPOs.
Yeah. So when you start to see those companies come and they have numbers, that's going to really be, I mean, you need these companies, you need IPOs, like, when Amazon came out and, and Google and all these companies, Roblox on their IPOs, Upstart, Affirm. We need something innovative to happen. I mean, there's Upstart went from 50 to 180 before it went from 180 to 10. Upstart went from 25 to 340 before it went from 340 all the way down to 14, $400 to $14. That's a haircut.
Yeah. I think someone's asking you a question about risk management.
Hey, Troy, by the way, how did I develop the screen for the 30 stocks? I got those 30 stocks from our screens, a combination of our screens. And let me show you what those screens in the list, what those look like. Favorites. Earnings, relative strength, new high, blue dot. Really, it's on our over here. Okay, this is the screens that we run, triple digit sales and earnings growth. There's that 85 that Wes mentioned earlier on the presentation board, within 15% of its 52-week high. Up, down, volume greater than 2.0, earnings up 20% this year and next year. Relative strength within 5% of new highs. IPOs over the last 3 years. Stocks up 10% today. Stocks up on volume, down on volume. 40% sales and earnings growth, plus some other ingredients. Stocks that are up 10% in price. Volumes up greater than 300. 100% earnings per share and revenue growth, 100% earnings growth, 100% relative growth with relative strength over 85. Top 200 composite. There's that weekly review from that IBD puts up there. The 70 to 79 earnings per share, relative strength over 85. And so so we run this relative strength at a new high, we run this, and then hand pick them basically. Here's that 70. See, this is some of these stocks, they're not going to be on the IBD. They're not going to hit the IBD screens because the earnings per share is not enough. But I found that a number of these, there's ONON, PagerDuty, PODD, Melly, NXT on that group that hit up. So we just try to run everything and then narrow it down and to do our research. And when the market's good, all of these work. So it's a combination of all that. Wes, did you drop the link for our email link?
Yes.
Okay. Okay, KR, I mentioned these two. The question, someone mentioned KR. I was watching this stock, KRUS,
Yeah.
and they did a secondary, I think. They did a secondary, it was well received. And this is, I mean, I love it looks pretty good online. I love the menu choices. It's a sushi restaurant. So they're looking to expand their footprint. And yeah, and this is what got my attention way back here, but it was real thin. And I owned some of it and got kicked out way back here and got a little trade out of it, and then it rolled over and it's been basing. There's the volume on the secondary today. And they're going to plan to open 200 restaurants in the near future. So it's, it's one of these easy to understand retail establishments. So this looks, it looks interesting. RVNC, someone asked about. There's earnings. Obviously, the new drug, new phase approval. It's got to be in like phase 1 or phase 2. Technically it's rolling over. You're technically rolling over, but earnings are in May 9th. So you're going to be stocks like this, you can't hold into the number. Minervini featured he's mentioned this stock that's just taking out 95. It's just broke out today. Already no numbers, but an ophthalmic ophthalmology drug. How do you buy something that went from 20 though to 100 in a day? I guess you buy it at 95.10.
Yeah.
That's how you do it. Okay. Nile says the Mobileye lockout is April 24th. Thank you, Nile. And you also asked about risk management. You really shouldn't risk more than 1% of your equity on any trade. 1% of your total equity on any trade. So you could have a 10% position and lose 1%. You could have a 1% stop. You could have a 10% position and lose 10%. That's it. But if you have a 2% position, you could lose a lot. You could lose a lot more. But we're trying to take 2% positions and lose 10%, that's 0.2% of equity. So that, so you have to have 5 losing trades like that to lose 1%. But in a good market, we're going to ramp up to, it's going to be 10% with the, with an 8% stop. The more that the larger your position, the tighter that stop needs to be. If you need to look at it from a dollar perspective as well, how much are you willing to lose from a drawdown from a capital perspective? And let me see, I mean, I don't like to have more than a 3% drawdown in my capital in one day. And that happens all the time, losing 3% of your capital in one day. If you're fully invested.
Do you put like a like let's say
do I put what?
I was gonna say you're fully invested, right? Like it's a good year, you're fully invested. Do you put like a threshold on how much of your portfolio drawdown you're willing to have from the top of your equity curve? Like let's say you're at new highs in your equity curve and you're like, okay, I'm not gonna have this much of a drawdown from my highs.
I don't, but I mean, in a bad market, it's anywhere from 10 to 30. I think when I was in that U.S. Investment Championship in 2021, I actually had a 30% drawdown and still was up 200%.
Yeah.
But the environment was, I mean, you don't want that, but you get on margin and you press your positions and you have a bad streak and, boom. And, you're losing 5% of your capital. You walk in and you're on margin and you could be down 10%.
Roy, when you were in that competition, what was the biggest position that you had at one time? Let's say.
I actually think, I think it was MicroStrategy, actually. Let me see. Let me check the date. 20. Yep. Yep. That was my biggest position. Right.
That have been like a 20% or position or?
I think I had, I probably had I had a 30 to 40% position for, for a month or there. This is, let me see. This is the monthly. What's that look like on the weekly?
That stock had some serious momentum at one time. I remember that.
Yeah, yeah. So, and actually, probably my drawdown came, maybe, so, I mean, this was a big winner. Where's 20? Yep. Right here. Yep, I did get this move.
It's funny that now that Bitcoin's coming back, people are starting to buy this up again. MicroStrategy. Yeah,
it is. Yeah, so that's I mean, so you strung together. It was at new highs, heavily shorted, and you got that move up, and so that was it went from 300 to 1,000, but I got kicked out of it on the pullback, I'm sure, with the trailing stop, maybe in here. Something like that. Again, if the market's conducive and you can handle the volatility, Bernard Baruch was famous investor, trader, counselor for many presidents. I think in the early 1900s, he was famous for saying, put all your eggs in one basket and watch that basket closely. And I've heard Buffett has quoted him as well. Buffett, he's probably got 80% of his whole fund in 10 names, billions and billions of dollars in 10 names probably. Guys, I think I'm gonna call it a night. Again, thank you for attending. I hope, especially the second part of the presentation, I hope you got a lot out of that. I hope that we did help you with a little bit of your homework so that you can focus on, we won't get all the names, but those were some really good names that you can take a look at. And all we need is the market environment to improve. So, be optimistic, of course, protect the downside from here, certainly. And remember that, it's going to, the environment's going to change, and we're always only a couple of days away from a serious new uptrend, and we're seeing some of these signals, but we just might be choppy for a little bit longer. But the longer that this bear market lasts, the more confident I am, after doing this 35 years, is that we're going to embark on just a tremendous upturn. When the real bull market resumes, and not just from a rotational standpoint, but exciting new leaders showing themselves, a plethora of new highs, and companies that are going to grow their revenues dramatically and their earnings likewise. So thank you again for attending. It's always a pleasure for Wes and I to do this, and we hope to see you next month.
Thank you, Roy. Take care. Have a great month.
Thanks, guys. Much appreciated.
Thank you very much. Great session.
You're welcome, guys. Go get them.
Thank you.
Everyone.